Berkshire Hathaway Incorporated. A note to readers, 50 years ago, today's management took charge of Berkshire. For this golden anniversary, Warren Buffett and Charlie Munger each wrote his views of what has happened at Berkshire during the past 50 years and what each expects during the next 50. Neither had changed the world of his commentary after reading what the other had written. Warren's thoughts begin here, and shareholders, particularly new ones, may find it useful to read those letters before reading the report in 2014, which begins still below. To the shareholders of Berkshire Hathaway Incorporated, Berkshire gains in net worth during 2014 was $18.3 billion, which increased the per share book value of both our Class A and Class B stock by 8.3%. Over the last 50 years, that is since present management took over, per share book value has grown from $19 to $146,186, a rate of 19.4% compounded annually. All per share figures used in the report apply to Berkshire's A shares. Figures for the B shares are the 1 to 1,500 of those shown for A. During our 10-year, we have consistently compared the yearly performance to the S&P 500, the change in Berkshire's per share book value. We've done that because book value has been the crude but useful tracking device for the numbers that really count intrinsic value. In our early decades, the relationship between book value and intrinsic value was much closer than it is now. That was true because Berkshire assets were the larger securities whose values were continuously restated to reflect their current market prices in Wall Street. Parlance, most of these assets involved in the calculation of book value were marked to market. Today, our emphasis has shifted in our major way to owning and operating large business, and many of these are worth far more than their cost-based carrying value, but that amount is never valued upward, no matter how much the value of these companies have increased. Consequently, the gap between Berkshire intrinsic value and its book value has materially widened. With that in mind, we have added a new set of data, the historical record of Berkshire's stock price to the performance table on the facing page. Market prices, let me stress, have their limitations in short terms. Monthly or yearly movements stock are often erratic and not indicative of changes in intrinsic value. Over time, however, stock price and intrinsic value almost invariably converge. Charlie Munger and Berkshire Vice Chairman and my partner, and I believe that has been true Berkshire, in our view, the increased Berkshire's per share intrinsic values over the past 50 years is roughly equal to the 1,826,163% gain in the market price of the company shares. Good year at Berkshire. It was a good year for Berkshire on all major fronts except one. Here are the important developments. Our Powerhouse 5 election of Berkshire largest non-insurance business had a record $12.4 billion of pre-tax earnings in 2014, up $1.6 billion from 2013. The companies in the Saying Group are Berkshire Hathaway Energy, formerly Mid-American Energy, BNSF, IMC, I've called it SCAR in the past, Liberal on Marmon. Throughout this letter, as well as in the golden anniversary letters included later in this report, all earnings are stated on a pre-tax basis unless otherwise designated. Of the 5, only Berkshire Hathaway Energy is earning $393 million was owned by us a decade ago. Subsequently, we purchased another 3 of the 5 on the all-cash basis. In acquiring the 5th, BNSF, we paid about 70% of the cost in cash, and for the remainder issued Berkshire shares increased the number outstanding by 6.1%. In other words, the $12 billion gain in annual earnings delivered Berkshire by the 5 companies over the 10-year span has been accompanied by only minor dilution that satisfies our goal of not simply increasing earnings, but making sure we also increase per share results. If the U.S. economy continues to improve in 2015, we expect earnings for our Powerhouse 5 to improve as well. The gain could reach $1 billion, in part because of the bolt-on acquisitions by the group that have already closed or are under contract. Our bad news from 2014 comes from our group of 5 as well, and is unrelated to earnings. During the year, BNSF disappointed many of its customers. These shepherds depends on us, and service failures can badly hurt their business. BNSF is by far Berkshire's most important non-insurance subsidiary. In terms of its performance, we will spend $6 billion on plant and equipment in 2015. That sum is nearly 50% more than any other railroad has spent in a single year, and it's truly extraordinary amount, whether compared to revenue, earnings, or depreciation charges. The weather, which particularly severe last year, will always cause railroads a variety of operating problems. Our responsibility is to do whatever it takes to restore our service to industry-leading levels. That can't be done overnight. The extensive work required to increase system capacity sometimes disrupts operation while it's underway. Recently, however, outsized expenditures during the last 3 months, BNSF's performance metrics have materially improved from last year's figures. Our many dozens of smaller non-insurance business earned $5.1 billion last year, up from $4.7 billion in 2013. Here's with our Powerhouse 5. We expect further gains in 2015. Within this group, we have 2 companies that last year earned between $400 million and $600 million, 6 that earned between $250 million, $400 million, and 7 that earned between $100 million, $250 million. This collection of business will increase in both number in earnings. Our ambitions has no finish line. Berkshire's huge and growing insurance operation again operated underwriting profit in 2014 that makes 12 years in a row and increases its float. During that 12-year stretch, our float money that doesn't belong to us but that we can invest for Berkshire's benefit has grown from $41 billion to $84 billion. So neither the gain nor size of our float, reflected in Berkshire's earning float, generates significant investment income because of the asset it allows us to hold. Meanwhile, our underwriting profit totaled $24 billion during the 12-year period, including $2.7 billion in 2014. All of this began with our 1967 purchase of National Indemnity for $8.6 million. While Charlie and I searched for new business to buy our many subsidiaries, regularly making bolt-on acquisitions last year was particularly fruitful. We contracted for 31 bolt-ons scheduled to cost $7.8 billion in aggregate. The size of these transactions ranged from $400,000 to $2.9 billion. However, the last acquisition, Duracell, will not close until the second half of this year. It will then be placed under Barma's jurisdiction. Charlie and I encourage bolt-ons if they are sensibly priced. Most deals offered us errant. They deploy capital and activities that fit with our existing business that will be managed by our corps of expert managers. This means no more work for us, yet more earnings combination I find particularly appealing. We will make more of these bolt-on deals in future years. 2 years ago, my friend Jorge Paulo Lemon asked Berkshire to join his 3G Capital Group in the acquisition of Heinz. My affirmative response was a no-brainer. I knew immediately that this partnership would work well from both personal financial standpoint, and it most definitely has. I'm not embarrassed to admit that Heinz is run far better under Alex Bering, Chairman, and Bernardo O'Hies. We're in charge. They hold themselves to extraordinary high performance standards and are never satisfied, even when the results far exceeded those of competitors. We expect to partner with 3G in more activities, sometimes more transportation will only involve a financing role. Was this a case of the recent acquisition of Tim Hortons by Burger King? Our favorite arrangement, however, will usually be the link up as a permanent equity partner who in some cases contributes to the finance of the deal as well. Whatever the structure, we feel good when working with Jorge Paulo. Berkshire also has fine partnership with Mars and Lucadia, and we may form new ones with them or with other partners. Our participation in any joint activities, whether it's financing or equity partner, will be limited to friendly transactions. In October, we contracted to buy Van Tuyl Automotive, a group of 78 automobile dealerships that is exceptional, well-run. Larry Van Tuyl, the company owner, I met him some years ago. He then decided that if he ever decides his company, his home should be Berkshire. Our purchase was recently completed. We are now car guys. Larry and his dad, Cecil, spent 62 years building this group, following a strategy made owner partners of all local managers. Creating this mutuality interest proved owner and overall winner. Ventol is now the fifth largest automotive group in the country, with per dealership sales figures that are outstanding. In recent years, Jeff Ratshore has worked alongside Larry's successful arrangement that will continue. There are about 17,000 dealerships in the country, and ownership transfers always require approval by the relevant auto manufacturer. Berkshire's job is to perform in a manner that will cause manufacturers to welcome further purchases. But if we do this, and if we can buy dealerships at sensible prices, we'll build all the business that before long will be multiple the size of Vantol's $9 billion of sales. With the acquisition of Vantol, Berkshire now owns 9.5% of the companies, would be listed on Fortune 500 the independent. Heinz is 1/2. That leaves 499 or 90 and 1/2 fish in the sea. Our lines are out. Our subsidiary spent a record $15 billion in plant equipment during 2014, well over twice the depreciation charges. About 90% of that money was spent in the United States, though we will always invest abroad as well. The budget load opportunities runs to America. The treasures that have been covered up to now are dwarfed by those still entrapped through dumb luck. Charlie and I were born in the United States, and we were forever grateful for the surrogate advantages this accident has been given to us. Berkshire's year-end employees, including those Heinz, totaled a record 340,499, up 9,754 from last year. This increase, I'm proud to say, included no gain at headquarters where 25 people work. No sense going crazy. Berkshire increased its ownership interest last year in each of its big four investments: American Express, Coca-Cola, IBM, and Wells Fargo. We purchased additional shares of IBM, increasing our ownership to 7.8% versus 6.3% a year in 2013. Meanwhile, stock repurchase of Coca-Cola, American Express, and Wells Fargo raised their percentage ownership of each. Our equity in Coca-Cola grew from 9.1% to 9.2%. Our interest in American Express increased from 14.2% to 14.8%. Our ownership of Wells Fargo grew from 9.2% and 9.4%. And if you think tenths of a percent are important, ponder this math. For the four companies, the aggregate increase of 0.1% in ownership raises Berkshire portion of their annual earnings by $50 billion. These four investees possess excellent business in our run by managers who are both talented and shareholder-oriented. At Berkshire, we much prefer owning controlling, but substantial portion of wonderful companies to owning 100% of a so-so business. It's better to have a partial interest in the Hope Diamond than to own all of Rhinestone. If Berkshire's year-end holdings are used as a marker, our option for the Big Four's 2014 earnings before discontinued operations amounted to $4.7 billion compared to $32.3 billion only 3 years ago, and the earnings we report to you, however, will include only the dividends we receive, about $1.6 billion last year. Again, 3 years ago, the dividends were $862 million, but make no mistake, the $3.1 billion of these companies' earnings we don't report are every bit as valuable to us as proportion Berkshire records. The earnings these investees retain are often used for purchase of their own stock, a move that enhances Berkshire's share of the future earnings without requiring us to lay out a dime. The retained earnings also fund business opportunities that usually turn out to be advantageous. All that leads us to expect that the per share earnings of these four investees in aggregate will grow substantially over time. Through 2015 will be a tough year in group part because of the strong dollar. If they expect that gains materialized dividends to Berkshire will increase, and even more important, so will earn realized capital gains. For the package of four, our unrealized gains already totaled $42 billion at year-end. Our flexibility in capital allocation, our willingness to invest in large sums passively, and non-controlled business give us significant advantage over companies that limit themselves to acquisition they can operate. Our appetite for either operating business or passive investment doubles our chances of finding sensible uses for Berkshire and securities of cash. I mentioned in the past that my experience in business helps me an investor, and that my investment experience has made me a better businessman. Each person teaches lessons that are applicable to the other, and some truths can be only fully learned through experience. In Fred Schutt's wonderful book, Where the Customer Yachts, Peter Arno, the cartoon, depicts a puzzled Adam looking at an eager Eve, while the captain says there are certain things that cannot be adequately explained to a virgin either by words or pictures. If you haven't read Schutt's book, buy a copy at our annual meeting. Its wisdom and humor are truly priceless. Among Arno's certain things I would include: 2. Separate skills, the evaluation of investment and management business. I therefore think it's worthwhile to it comes to Todd Bushler or 2 investment managers to each have oversight of at least one of our business, a sensible opportunity for them to do so. To spend a few months ago when we agreed to purchase 2 companies that through smaller than we would normally acquire, have excellent economic characteristics. Combined, the 2 earn $100 million annually on about $125 million in net tangible assets. I've asked Todd and Ted to each take on one as chairman, in which role they will function in a very limited way that I do with our largest subsidiaries. This arrangement will save me a minor amount of work and, more important, make the 2 of them even better investors than they already are, which is to say among the best. Late in 2009, amidst the gloom of rate recession, we agreed to buy BNSF, the largest purchase in Berkshire history. At the time, I called the transaction an all-in wager in economic futures in the United States. That kind of commitment was nothing new for us. We've been making similar wagers ever since Buffett Partnership Limited acquired control of Berkshire in 1965 for a good reason too. Charlie and I have always considered a bet on ever-rising U.S. prosperity to be very close to sure thing. Indeed, who has ever benefited during the past 238 years by betting against America? If you compare our country present condition that exists in 1776, you have to rub your eyes and wonder if my life alone, real per capita U.S. output has sextupled. My parents could not have dreamed in 1930 of the world their son would see. So, though the preachers of pessimism prattle endlessly about America's problem, I've never seen one of those who wishes to emigrate, though I can't think of a few for whom I would happily buy a one-way ticket. The dynamism embedded in our market economy will continue to work its magic. Gains won't come in smooth or untrapped manner. They never have, and we will regularly grumble about our government, but mostly surely America's best days lie ahead. With this tailwind working for us, Charlie and I hope to build Berkshire's per share intrinsic value by constantly improving the basic earnings power of our many subsidiaries. 2, further increasing their earnings through bolt-on acquisitions, benefits from the growth of our investees. 4, repurchasing Berkshire shares when they are available at meaningful discount from intrinsic value. And 5, making an occasional large acquisition. We'll also try to maximize results for you by rarely if ever issuing Berkshire shares. Those building blocks address a rock-solid foundation, a century hence BNSF and Berkshire Hathaway Energy will still be playing vital roles in our economy. Homes and autos will remain central to the lives of most families. Insurance will continue to be essential for both business and individuals. Looking ahead, Charlie and I see a world to meet the order for Berkshire. We feel unfortunate to be entrusted with its management. Intrinsic business value. As much Charlie and I talk about intrinsic business value, we cannot tell you precisely what the number is for Berkshire shares, nor in fact any other stock. In our 2010 annual report, however, we laid out on 3 elements, one of them qualitative, that we believe are the keys to a sensible estimate of Berkshire intrinsic value. That discussion is reproduced in full pages 123 to 124. Here's an update of the 2 quantitative factors. In 2014, our per share investment increased 8.4% to $140,123. And our earnings from business other than insurance and investment increased 19% to $10,847 per share. Since 1970, our per share investment have increased at a rate of 19% compounded annually, and our earnings figure has grown at 20.6% clip. It is no coincidence that the price Berkshire stock over insuring 44 years has increased at a rate very similar to that over 2 measures of value. Charlie and I like to see gains in both sectors, but our main focus is to build operating earnings. That's why we were pleased to exchange our Phillips 66 and Graham's holding stock for operating business last year into contact with Procter & Gamble to acquire Duracell by means of a similar exchange set to close in 2015. Now let's examine the four major sectors of operations. Each has vastly a balance of sheet and income characteristics from others, so we'll represent them as four separate business, and which is how Charlie and I view them, though there are important enduring advantages to having them all under one roof. Our goal is to provide you with the information we would wish to have if our positions were reversed, with you being the reporting manager and we the absentee holder, shareholders, but don't get any ideas. Insurance. Let's look at first insurance. Berkshire's core operations. That industry has been the engine that has propelled our expansion since 1967, when we acquired National Indemnity and its sister company National Fire and Marine for $8.6 million, though that purchase had monumental consequences for Berkshire. Its execution was simplicity itself. Jack Ringwald, a friend of mine who was a controlling shareholder of the two companies, came to my office saying he would like to sell. 15 minutes later, we had a deal. Neither of Jack's companies had ever an audit by a public accounting firm. I didn't ask for one. My reasoning: 1, Jack was honest. 2, he was also a bit quirky and likely to walk away with the deal. It became all complicated. In pages 128 to 129, we reproduce one to 1.5 page purchase agreement. We used the finalist transaction. The contract was homemade. Neither side used a lawyer. Per page, this has to be Berkshire's best deal nationwide. National Indemnity today has GLP Journal accepted accounting principles net worth of $111 billion, which exceeds that of any other insurer in the world. One reason we were attracted to property casualty business was its financial characteristics. PC insurers receive premium upfront and pay claims later. In extreme cases, such as those arising from certain workers, compensation accidents payments can stretch over many decades. This collect now, pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest float for their benefit. Though individual policies and claims come and go, the amount of float an insured holds usually remains fairly stable in relation to the premium volume. Consequently, as our business grows, so does our float. And how we have grown, as the following table shows. Year float in millions. 1970, $39. 1980, $437. 1990, $1,632. 2000, $27,871. 2010, $65,832. 2014, $83,921. Further gains in float will be tough to achieve. On the plus side, Geico and our new commercial insurance operation almost starting to grow at a good clip. National Indemnity Insurance Division, however, is a party to a number to run off contracts whose flows drifts downwards. If we do in time experience a decline in float, it will be very gradual. On the outside, no more than 3% in any year. The nature of our insurance contract is such that we can never be subject to immediate demands for unit sums that are large compared to other cash resources. This strength is a key pillar in Berkshire's economic fortress. If our premiums exceed the total of expenses and eventually losses, we register underwriting profit that adds to the investment income our float produces. When such profit is earned, we enjoy the use of free money and better yet get paid for holding. Unfortunately, the wish of all insurers to achieve this happy result creates intense competition to vigorous indeed that it frequently causes the PC industry as a whole to operate a significant underwriting loss. This loss in effect is what industry plays to hold its float. Competitive dynamics almost guarantee that the insurance industry, despite the float income all its companies enjoy, will continue its dismal record of earnings of normal returns or tangible net worth as compared to other American businesses. The prolonged period of low interest rates our country is now dealing with caused earnings on float to decrease, thereby exacerbating the profit problems in the industry. As noted in the first section of this report, Berkshire has now operated an underwriting profit for 12 consecutive years. Our pre-tax gain for the period having totaled $24 billion. Looking ahead, I believe we will continue to underwrite profitably in most years. Doing so is the daily focus of all insurance managers who knows that while float is valuable, its benefits can be drowned by poor underwriting results. That message is given least lip service by all insurers, all Berkshires. It is religion. So how does our float affect intrinsic value? When Berkshire's book value is calculated, the full amount of our float is deducted as a liability, just as if we had to pay it out tomorrow and could not replenish it. But if you think of float as strictly a liability is incorrect, it should instead be viewed as a revolving fund. Daily, we pay old claims and related expenses a huge $2.7 billion to more than 6 million claimants in 2014, and that reduces float. Just surely we each day write new business and thereby generate new claims that add float. If our revolving float is both costless and long enduring, which I believe it will be true, value of this liability is dramatically less than the accounting liability. Owing $1 then in effect will never leave the premise because new business is almost certain to deliver a substitute, as well as different from owning $1 that will go out the door tomorrow and not be replaced. The two types of liabilities are treated as equals, however, under GAAP. A partial offset to this overstated liability is a $15.5 billion goodwill asset that we incurred in buying our insurance companies and tried to increase book value. In very large part, this goodwill represents the price we paid for the float generating capabilities for insurance operations. The cost of the goodwill, however, has no bearing on its true value. For example, if an insurance company sustains large and prolonged underwriting losses and any goodwill asset carried on the book should be deemed valueless, whatever its original cost. Fortunately, it does not describe Berkshire. Charlie and I believe the true economic value of our insurance goodwill would happily pay for a float, terminally quality. We too purchased an insurance operation, processing it to be far in excess of its historic carrying value under present accounting rules, which we agree the excess value will never be entered on our books. But I can assure you that it's real. That's one reason, a huge reason why we believe Berkshire intrinsic business value substantially exceeds book value. Berkshire's attractive insurance economics exists only because we have some terrific managers running disciplined operations. It possesses hard to replicate business models. Let me tell you about the major units. First, by float size, the Berkshire Hathaway Insurance Group, managed by Ajit Jain. Ajit insures risks that no one else has desired for the capital to take on its operation, combined capacity, speed, decisiveness, and most important, brains in a manner unique in the insurance business, yet he never exposed Berkshire to risk that are inappropriate in relation to our resources. Indeed, we are far more conservative in avoiding risk than most large insurers. For example, if the insurance industry should experience a $250 billion loss from some mega catastrophe, also about triple anything it has ever experienced, Berkshire as a whole would likely record a significant profit for the year because of its many streams of earnings. We would also remain awash in cash and be looking for large opportunities in the market that might as well have gone into shock. Meanwhile, other major insurers and reinsurers would be far in the red, if not facing insolvency. Ajit's underwriting skills are unmatched. His mind, moreover, is an idea factory that is always looking for more lines of business he can add to his current assortment. Last year, I told you about his formation of Berkshire Hathaway Specialty Insurance, BHSI. This initiative took us into commercial reinsurance, where we were instantly welcomed by both major insurance brokers and corporate risk managers throughout America. Previously, we had written only a few specialized lines of commercial insurance. BHSI is led by Peter Eastwood, an experienced underwriter who is widely respected in the insurance world. During 2014, Peter expanded his talented group, moving into both international business and in new lines of insurance. We repeat last year's prediction that BHSI will be a major asset for Berkshire, one that will generate volume and influence within a few years. We have another insurance powerhouse in General Ray, managed by Ted Montross. At bottom, its sound reinsurance operation needs to adhere to 4 disciplines. It must, 1, understand all exposures that might cause a policy to incur losses. 2, conservatively assess the likelihood of any exposure actually causing a loss and the probable cost if it does. 3, set a premium that on average will deliver a profit after both prospective loss costs and operating expenses are covered. And 4, be willing to walk away with the appropriate premium can't be obtained. Many insurers pass the first 3 tests and flunk the 4th. They simply can't turn their back on business that is being eagerly written by their competitors. They don't like the other guys doing it, so we must as well. Spells trouble in the business, but it's none more than so insurance. That has observed all 4 of the insurance commandments. It shows in this result. General Ray's huge float has been considerably better than cost-free under his leadership, and we expect that on average continue. We are particularly enthusiastic about General Ray's international life insurance business, which has grown consistently and profitably since we acquired the company in 1998. It can be remembered that soon after we purchased General Ray, it was beset by problems, and it caused commentators and me as well briefly to believe I had a huge mistake. That day is long gone. General Ray is now a gem. Finally, there's Geico, the insurer on which I cut my teeth. 64 years ago, Geico is managed by Tony Nicely, who joined the company at 18 and completed 53 years of service in 2014. Tony became CEO in 1993, and since then, the company has been flying. There's no better manager than Tony. When I was first introduced to Geico in January 1951, I was blown away by the huge cost advantage the company enjoyed compared to the expenses borne by the giants of the industry. It was clear to me that Geico would succeed because it deserved to succeed. No one likes to buy auto insurance. Almost everyone likes to drive. The insurers consequently needed a major expenditure for most families. Savings matter to them, and only a low-cost operation can deliver these. Indeed, at least 40% of the people reading this letter can save money by insuring with Geico. So stop rating and go to geico.com or call 800-368-2734. Geico's cost advantage is the factor that has enabled the company to gobble up market share year after year. We ended up 2014 10.8% compared to 2.5% in 1995 when Berkshire acquired control of Geico. The company's low cost created a moat, an enduring one that competitors are unable to cross, or Geico never tries to sell Americans how Geico can save them important money. The Geico, I should add, had one particular enduring quality. He works without pay. Unlike a human spokesperson, he never gets a swelled head from his fame, nor does he have an agent to constantly remind us how valuable it is. I love that little guy. In addition to our 3 major insurance operations, we own a group of smaller companies, most of them plying their trade in odds corners of the insurance world. In aggregate, these companies are growing operation that consistently delivers an underwriting profit. Indeed, over the past decades, they have earned $2.95 billion from underwriting while growing their float from $1.7 billion to $8.6 billion. Charlie and I treasure these companies and their managers. Insurance operations, BH Insurance, General Ray, Geico, as our primary underwriting profit. In millions, year-end float, 2014, $606, $277, $1,259, $626, $2,668. 2013, $1,294, $283, $1,127, $385, $3,089, 2014, $42,454, $19,280, $13,569, $8,618, $83,921. 2013, $37,231, $20,013, $12,566, $7,430, $77,040. Simply put, insurance is the sales of promise. The customer pays money now. The insurer promises to pay money in the future should certain unwanted events occur. Sometimes the promise will not be tested for decades. Think of life insurance bought by people in their 20s. Therefore, both the ability and willingness of insurers to pay even if economic chaos prevails. When payment time arrives is all important. Berkshire promises have no equal effect. Affirmed in recent years by certain of the world's largest and most sophisticated PC insurers who wish to shed themselves with huge exceptionally long-lived liabilities. That is, these insurers wish to see these liabilities, most of them potential losses, from asbestos claims to our insurer. They needed the right one. The insurer fails to pay a loss, and the original insurer is still on the hook for it. Choosing an insurer, therefore, that down road proves to be financially strapped or a bad actor, rather than the original insurer with getting huge liabilities right back in its lap. Last year, our premier position in their insurance was reaffirmed by a writing policy carrying a $3 billion single premium. I believe that the policy size has only been exceeded by our 2007 transaction, with Lloyd's in which the premium was $7.1 billion. In fact, I know only of a PC policy in history that has single premium exceeding $1 billion, and yes, all 8 were written by Berkshire. Certain of these contracts would require us to make substantial payments 50 years from now, when major insurers have needed questionable promise that payments of this type will be made. Berkshire has been to the party, the only party to call. Berkshire has great managers, premier financial strength, and a variety of business models protected by wide moats amount to something unique in the insurance world. This assemblage of strength is a huge asset for Berkshire shareholders that will only get more valuable with time. Regulate capital-intensive business. We have 2 major operations, BNSF and Berkshire Hathaway Energy, BHE, that share important characteristics distinguishing them from our other business. Consequently, we send them with their own section in this ladder and split our out their combined financial statistics in our GAAP balance sheet and income statement. A key characteristic of both companies is their huge investment in very long-lived regulated asset, which is partially funded by large amounts of long-term debt that is not guaranteed by Berkshire. Our credit is in fact not needed because each company has earning power that even under terrible economic conditions will far exceed its interest requirements. Last year, for example, BNSF's interest coverage was more than 8-1. Our definition of coverage is pre-tax earnings and interest, not EBITDA interest, a commonly used measure we view as seriously flawed. At BHE, meanwhile, 2 factors ensure the company's ability to service its debt under all circumstances. The first is common Dell Utilities recession-resistant earnings, which results from these companies offering an essential service on an exclusive basis. The second is enjoyed by few other utilities, a great diversity of earning streams which shield us from being seriously harmed by any single regulatory body. Recently, we have further broadened that base through our $3 billion Canadian acquisition of AltaLink, an electric transmission system serving 85% of Alberta's population. This multitude of profit streams, supplemented by the inherent ventures being owned by a strong parent, has enabled BHE and its utility subsidiaries to significantly lower their cost of debt. This economic fact benefits both of us and our customers. Every day, our subsidiaries power the American economy in major ways. BNSF carries about 15% measured by ton miles of all intercity freight, whether it is transported by truck, rail, water. Indeed, we move more ton miles of goods than anyone else, a fact establishing BNSF as the most important artery in our economy's circulatory systems. BNSF, like railroads, also move its cargo in an extraordinarily fuel-efficient and environmentally friendly way, carrying a ton of freight above 500 miles on a single gallon of diesel fuel. Trucks taking the same job guzzle about 4 times as much fuel. BHE's utilities serve regulated retail customers in 11 states. No utility company stretches further. In addition, we are a leader in renewable. From a standing start 10 years ago, BHE now accounts for 6% of the country's wind generation capacity and 7% of its solar generation capacity. Beyond this business, BHE owns 2 large pipelines that deliver 8% of our country's natural gas consumption. They recently purchased electric transmission operating in Canada and major electric business in UK and the Philippines, and the beat goes on. We'll continue to buy and build utility operations throughout the world for decades to come. BHE can make these investments because it retains all of its earnings. In fact, last year the company retained more dollars for earnings by far than any other American electric utility. We are regular to see this 100% retention policy an important advantage, one almost certain to distinguish BHE from other utilities for many years to come. When BHE completes certain renewables projects that are underway, the company's renewable portfolio will have cost $15 billion. In addition, we have conventional projects in the works that will also cost many billions. We relish making such commitments as long as they promise reasonable returns, and on that front we put a large amount of trust in future regulation. Our confidence is justified both by our past experience and by the knowledge that society will forever need massive investment in both transportation and energy. It is in self-interest of government to treat capital providers in a manner that will ensure the continued flow of funds to essential projects. It is concomitantly in our self-interest to conduct our operation in a way that earns approval of our regulators and the people they represent. Last year, we fully met this objective at BHC, just as we have in every year of our ownership. Our rates remain low, our customer satisfaction is high, our record for employee safety is among the best in the industry. The story at BNSF, however, as I noted earlier, was not good in 2014, a year in which railroad disappointed many of its customers. This problem occurred despite the record capital expenditures that BNSF has made in recent years, with those having far exceeded the outlays made by Union Pacific, our principal competitor. The two railroads are roughly equal size measured by revenues, though we carry considerably more freight measured either by carloads or ton miles, but our service problems exceeded Union Pacific's last year, and we lost market share as a result. Moreover, UP's earnings beat ours by a record amount. Clearly, we have a lot of work to do. We are wasting no time. As I also mentioned earlier, we will spend $6 billion in 2015 on improving our railroads operation. That will amount to about 26% of estimated revenues, a calculation that serves as the industry's yardstick. Outlays of the mismatch are largely unheard of among railroads, for this percentage compares to our average 18% in 2009-2013 and to UP's projection for the near future of 16 to 17%. Our recent investment will soon lead to a system with greater capacity and much better service. Improved profits should follow. Here are the key figures for Berkshire Hathaway Energy and BNSF. Berkshire Hathaway Energy, 89.9% owned. Earnings in millions. UK Utilities, 2014, 2013, 2012. Iowa Utility, Nevada Utility, Pacific Corp, primarily Oregon and Utah. Gas Pipelines, Northern National and Kern River. Home Services, Other. Net operating earnings before corporate interest and taxes. Interest, income taxes, net earnings. Earnings applicable to Berkshire. 2014, 527, 298, 549, 1010, 379, 139, 236, 3138, 427, 616, $2,095, $1,882, 362, 230, blank, 282, 385, 139, 4, 2,102, 2,196, 170, 1,636, 1,470, 4,229, 236, 737, 383, 82, 91, 1,958, 314, 172, 1,472, 1,323. BNSF, earnings in millions. Revenues 2014, 2013, 2012. Revenues $23,239 to $16,237, $7,002, $833, $2,300, $3,869, 2013, 22,014, 15,357, 6,657, 729, 2,135, 3,793. 2012, 20,835, 14,835, 6,623, 2005, 3,372. Manufacturing, service, and retailing operations. Our activities in this part of Berkshire cover the waterfront. Let's look through our summary balance sheet and earnings statement for the entire group. Balance sheet 12/31/14 millions. Assets, cash and equivalents, accounts and notes receivable, inventory, other current assets, total current assets, goodwill and other intangibles, fixed assets, other assets. $5,765, $8,264, $10,236, $1,117, $25,382, $20,107, $13,806, $3,793, $71,088. Liabilities and equity, notes payable, other current liabilities, total current liabilities, deferred taxes, term debt and other liabilities, non-controlling interest, Berkshire equity. $965, $9,734, $10,699, $3,801, $4,269, $492, $51,827, $71,088. Earnings statement in millions. Revenues 2014, 2013, 2012, $97,689. $93,772, $81,432, $90,788, $87,208, $75,734, $109, $140, $112, $6,792, $6,160, $5,586, $2,324, $2,283, $2,229, $4,468, $3,877, $3,357. Earnings for 2012-2013 have been stated to exclude Marmon's leasing operations, which are now included in the finance financial products section. Our income expense data confirming to GWP is on page 49. In contrast to operation expense figures above, our non-GWP excludes some purchase accounting items for primarily the amortization of certain intangible assets. We present that data in this manner because Charlie and I believe that adjusted numbers more accurately reflect the true economic expenses and profits of the business aggregated. In the table, then do GWP figures. I won't explain all of the adjustments. Some are tiny and arcane, but serious investors should understand the disparate nature of intangible assets. Some truly deplete over time, while others in a way lose value. For software, as a big example, amortization charges for variable expenses. The concept of making charges against other intangibles, such as amortization of a customer relationship, however, arises through purchases, accounting rules, and clearly does not reflect reality. GWP accounting draws no distinction between the two types of charges, both that is, are recorded as expensive when earnings are calculated, even though from an investor's viewpoint they could not be more different. In the GWP compliant figures we show on page 49, amortization charges of $1.15 billion have been deducted as expenses. We would call about 20% of these real, the rest not. The non-real charges, ones not accepted at Berkshire, have become significant because of the many acquisitions we have made. Non-real amortization charges will almost certainly rise further as we acquire more companies. The GWP compliant table on page 67 gives you the current status of our intangible assets. We now have $7.4 billion left to amortize, which $4.1 billion will be charged over the next 5 years. Eventually, of course, every dollar of non-real costs become entirely charged off. When that happens, reported earnings increase even if true earnings are flat. Depreciation charges, we want to emphasize, are different every dime of depreciation expense we report as a real cost. That's true, moreover, at most other companies when CEOs tote EBITDA as a valuation guide with a polygraph test. Our public reports of earnings will, of course, continue to conform to GWP to embrace reality. However, you should remember to add back most of the amortization charges we report. To get back to our many manufacturing services and retailing operations, they sell products ranging from all the passenger airplanes. Most of the sector's business, measured by earnings on unleveraged net tangible assets, enjoy terrific economics, producing profits that run from 25% after tax to far more than 100%. Others generate good returns in the area of 12% to 20%. A few, however, have very poor returns. The result of some serious mistake I made in my job of capital allocations. I was not misled. I simply was wrong in my evaluation of the economic dynamics of the company or the industry in which it operates. Fortunately, with my blunder normally involved relatively small acquisitions, our large buys have generally worked out well, and in few cases more than well. I have not nonetheless made my last mistake in purchasing either a business or stocks. Not everything works out as planned. Viewed as a single entity, the companies in this group are an excellent business. They employed an average $24 billion of net tangible assets during 2014, and despite their holding large quantities of excess cash and using low leverages, earned 18.7% after tax on that capital. Of course, a business with terrific economics can be a bad investment if it's bought for too high a price. We have paid substantial premiums to net tangible assets for most of our business, a cost just reflecting the large figure we show for goodwill. Overall, however, we are getting a decent return on the capital we have deployed in this sector. Furthermore, the intrinsic value of this business and aggregate exceeds our carrying value by a good margin, and that premium is likely to widen. Even so, the difference between intrinsic value and carrying value in both the insurance and regulated industry segments is far greater. It is clear that the truly big winners reside. We have far too many companies in this group to comment on them individually. Moreover, the competitors, both current and potential, read this report in a few of our business. We might be at the advantage of others, newer members, and some of our operations that are not as material to an evaluation of Berkshire. Therefore, we only disclose what is required. You can find a good bit of detail about many of our operations, however, in pages 97 to 100. Finance and financial products. This year will include a section of Marmon's very sizable leasing operations whose wares are rail cars, containers, and cranes. We have also restated the previous 2 years to reflect that change. Why have we made it? At one time, there was a large minority ownership at Marmon, and I felt it was more understandable to include all of the company's operations in one place. Today, we own virtually 100% of Marmon, which makes me think you will gain more insight into our various businesses if we include Marmon's leasing operation under its heading. The figures for the many dozens of Marmon's other business remain in the previous section. Our other leasing rental car operations are conducted by TORT, Furniture, and Extra Semi Trailers. These companies are industry leaders and have substantially increased their earnings. The American economy has gained strength. Both companies have invested more money in new equipment than have many other competitors. That's paying off. Kevin Clayton has again delivered an industry-leading performance at Clayton Homes, the largest home builder in America. Last year, Clayton sold 30,871 homes, about 45% of the manufactured homes bought by Americans. When we purchased Clayton in 2003 for $1.7 billion, its share was 14%. Key to Clayton's earnings, the company's $13 billion mortgage portfolio during the financial panic of 2000-2009. When funding for the industry dried up, Clayton was able to keep lending because of Berkshire's backing. In fact, we continued during that period of our finance, our competitors' retail sales, as well as our own. Many of Clayton's borrowers have low incomes and mediocre FICO scores, but thanks to the company's sensible lending practices, its portfolio performed well during the recession, meaning a very high percentage of our borrowers kept their homes. Our blue-collar borrowers in many cases proved much better credit risk than their higher-income brethren. At Marmon's railroad cars operation, lease rates have improved substantially over the past few years. The nature of this business, however, is that the only 20% or so of our leases expire annually, consequently improved. Pricing only gradually works its way into our revenue stream. The trend, though, is strong. Our 105,000 car fleet consists largely of tank cars, but only 8% of those transport crude oil. One further fact about our rail operations is important for you to know. Unlike many other lessors, we manufacture our own tank cars, about 6,000 of them. In a good year, we do not book any profit when we transfer cars from our manufacturing division to our leasing division. Our fleet is consequently placed on our books at a bargain price. The difference between that figure and retail price is only slowly reflected in our earnings through smaller annual depreciation charges that we enjoy over the 30-year life of the car, because of the fact that, as well as other Marmon's rail fleet, is worth considerably more than $5 billion figure at which it carried in our books. Here's the earnings recap for the sector. Berkshire, our 50% share. Clayton, Court, Marmon Containers and Cranes, Marmon Rail Cars Extra, net financial income. 2014, $122, $558, 36, 238, 452, 147, 296, $1,839. 2013 in millions, $80, 416, 40, 226, 353, 125, 324, 1,564. 2012, $35, 255, 42, 246, 299, 106, 410, 1,393. Excludes capital gains or losses. Investment below we list our 15 common stock investment that year-end had the largest market value. 151,610,700, 400 million, 18,513,482, 15,430,586, 24,617,939, 13,062,594, 76,971,817, 24,669,778, 20,060,390, 52,477,678, 22,169,930, 96,890,665, 43,387,980, 67,707,544, 483,470,853. Company: American Express Company, the Coca-Cola Company, the Vida Healthcare Partners Incorporated, Deere and Company, DirecTV, the Goldman Sachs Group, the International Business Machines Corporation, Moody's Corporation, Munich Re, the Procter & Gamble Company, Sanofi, U.S. Bancorp, USG Corporation, Walmart Stores Incorporated, Wells Fargo and Company, others. Total common stock share in market. Percentage of company owned: 14.8, 9.2, 8.6, 4.5, 4.9, 3.0, 7.8, 12.1, 11.8, 1.9, 1.7, 5.4, 30.0, 2.1, 9.4. Cost in millions: $1,287, $1,299, $843, $1,253, $1,554, 750, 13,157, 248, 2,990, 336, 1,721, 3,033, 836, 3,798, 11,871, 10,180. Total 55,056. 14,000 market: $14,106, $16,888, 1,402, 1,365, 2,134, 2,532, 12,349, 12,364, 4,023, 4,683, 2,032, 4,355, 1,214, 5,815, 26,504, 15,704, $117,470. There's our actual purchase price and also our tax basis. GWP cost differs in a few cases because of write-ups or write-downs that have been required under GWP rules. Exclude shares held by pension funds of Berkshire subsidiaries held under contracts for sale of this amount. Berkshire has one major equity position that is not included in the table. We can buy 700 million shares of Bank of America at any time prior to September 2021 for $5 billion. At year-end, these shares were worth $12.5 billion. We are likely to purchase the shares just before expiration of our option. In the meantime, it is important for you to realize that Bank of America is in effect our fourth largest equity investment and one we value highly. Attentive readers will notice that Tesco, which last year appeared on the list of our largest common stock investment, is now absent. An attentive investor embarrassed to report would have sold Tesco shares earlier. I made a big mistake with this investment by dawdling. At the end of 2012, we owned 450 million shares of Tesco, then and now leading food retailer in the UK and an important grocer in other countries as well. Our cost for this investment was $2.3 billion in a market value value was a similar amount. In 2013, I soured somewhat on the company's then management and sold 140 million shares, realizing a profit of $43 million. My leisurely pace in making sales would prove expensive. Charlie calls this sort of behavior thumb-sucking. Considering what Madelli cost us, he is being kind. During 2014, Tesco's problem worsened by the month. The company's market share fell. Its margins contracted and accounting problems surfaced. In the world of business, bad news often surface serially. You see cockroaches and crickets as the days go by. You meet as relatives. We sold Tesco shares throughout the year, and we are now out of the position. The company, we should mention, has hired new management, and we wish them well. Our after-tax loss from this investment was $444 million, about 1/5 of 1% Berkshire's net worth in the past 50 years. We have only once realized an investment loss at the times of sale cost us 2% of our net worth. Twice we experienced 1% loss. All three of these losses occurred in the 1974 to 1975 period when we sold stocks that were very cheap in order to buy others we believe to be even cheaper. Our investment results have been helped by a terrific tailwind during 1964 to 2014 period. The S&P 500 rose from 84 to 2059, which was reinvested dividends, generated an overall return of 11,196%. Shown on page 2, currently the purchasing power of the dollar declined a staggering 87%. That decrease means that it now takes $1 to buy what could be bought for 13 cents in 1965, as measured by the Consumer Price Index. There's an important message for investors in that disparate performance between stocks and dollars. Think back to our 2011 annual report, in which we defined investing as the transfer to others of purchasing power. Now, with this recent expectations of receiving more purchasing power after taxes have been paid on nominal gains in the future. An unconventional but inescapable conclusion to be drawn from the past 50 years is that it has been far safer to invest in a diversified collection of American business than to invest in securities, treasuries, for example, whose values have been tied to American currency. That was also true in the preceding half century, a period including the Great Depression, the two world wars. Investors should heed this history. To one degree or another, it's almost certain to be repeated during the next century. Stock prices will always be far more volatile than cash equivalent holdings. Over the long term, however, currency-denominated instruments are riskier investment, far riskier investment than widely diversified stock portfolios that are bought over time and that are owned in a manner invoking only token fees and commissions. That lesson has not customarily been taught in business schools, where volatility is almost universally used as a proxy for risk. Though this pedagogic assumption makes for easy teaching, it is dead wrong. Volatility is far from synonymous with risk. Popular formulas that equate the two terms lead students, investors, and CEOs astray. It is true, of course, that owning equities for a day or a week or a year is far riskier in both nominal and purchasing power terms than leaving funds in cash equivalents. That is relevant to certain investors, say investment banks, whose viability can be threatened by declines in asset prices, of which might be forced to sell securities, adding depressed markets. Additionally, any party that might have meaningful near-term needs for funds should keep appropriate sums in treasuries or issued bank deposits. For the great majority of investors, however, who can and should invest with a multi-decade horizon, quotational declines are important. Their focus should remain fixed on attaining significant gains. Purchasing power over their investing lifetime for them, a diversified equity portfolio bought over time will prove far less risky than dollar-based securities. If the investor instead fears price volatility and earnestly viewing it as a measure of risk, he may erotically end up doing some very risky things. Recall if you will do pundits who 60 years ago bemoaned falling stock prices and advised investing in safe treasury bills or bank certificates of deposit. People who heeded this sermon are now earning a pittance on sums they had previously expected would finance a pleasant retirement. The S&P 500 was then below 700. Now it's at about 2,100, if not for their fear of meaningless price. Averaged themselves a good income for life by simply buying a very low-cost index fund whose dividends would trend upward over the years and whose principal would grow as well, with many ups and downs to be sure. Investors, of course, can by their own behavior make stock ownership highly risky, and many do. Active trading attempts to time market movements and adequate diversification, the payment of high unnecessary fees to managers and advisors, and these of borrowed money can destroy the decent returns that a lifelong owner equities would otherwise enjoy. Indeed, borrowed money had no place in the investor's toolkit. Anything can happen anytime, and markets and no advisor, economist, or TV commentator indefinitely, nor Charlie nor I, can tell you when chaos will occur. Market forecaster will fill your ear, but will never fill your wallet. The commission of the investment listed above is not limited to the little guy. Usually, institutional investor review this group have long underperformed than for sophisticated index fund investor who simply sits tight for decades. A major reason has been fees. Many institutions pay substantial sums to consultants who in turn recommend high fee managers, and that is a fool's game. There are a few investment managers, of course, who are very good, though short run it's difficult to determine whether a great record is due to luck or talent. Most advisors, however, are far better at generating high fees than they are generating high returns. In truth, their core competence is salesmanship rather than listen to recite songs. Investors, large and small, should instead read Jack Bogle's The Little Book of Common Sense Investing. Decades ago, Ben Graham pinpointed the blame for investment failure using a quote from Shakespeare: "The fault, dear Brutus, is not our stars, but in ourselves." The annual meeting will be held on Saturday, May 2nd at the Central Link Center. Last year's attendance, 39,000, set a record, and we expect a further increase this year as we'll celebrate our golden anniversary. Be there when the doors open at 7 a.m. Berkshire's talented Kerry Sova will again be in charge. Kerry joined us 6 years ago at the age of 20 as secretary. Then 4 years ago, I asked her to take charge of the meeting. A huge undertaking required a multitude of skills, and she jumped at the chance. Kerry is inflammable and genius and expert at bringing out the best in hundreds who work with her. She is aided by our entire home office crew who enjoy pitching in to make the weekend fun and informative for our owners. And yes, we also try to sell our visiting shareholders our products while they're here. In fact, this year, we will substantially increase the hours available for purchase opening for business at the Central Link on Friday, May 1st from noon to 5 p.m., as well as the usual 7 a.m. to 4 p.m. on meeting day. So bring a smile to Charlie's face and do some serious shopping. Get up early on Saturday morning at 6 to 20 a.m. Norman and Jake, 2 Texas Longhorns, each weighing about a ton, will proceed down 10th Street to the Central Link. Aboard them will be a couple of our Justin Boot executives who do double duty as cowboys. Following the steers will be 4 horses pulling wheels. Wells Fargo Stagecoach, Berkshire already market planes, trains, and automobiles. Adding steers and stagecoaches to our portfolios should steal our reputation as America's all-purpose transportation company. At about 7:30 a.m. on Saturday, we'll have 4th International Newspaper Tossing Challenge. Our target, again, will be a Clayton home porch located precisely 35 feet from the throwing line. When I was a teenager and my own brief flirtation with honest labor, I tossed 500,000 papers, so I think I'm pretty good. Challenge me, humiliate me, knock me down a peg. I'll buy a dilly bar for anyone who lands his or her throw closer to the doorstep than I do. The papers will run 36 to 42 pages, so you must fold them yourself. No rubber bands allowed. I'll present a special prize to the 12 or under contestant who makes the best toss. Deb Bosenek will be the judge. At 8:30 a.m., new Berkshire movie will be shown an hour later. We'll start the question and answer period, which was a break for lunch at Central Link Stance, will last until 3:30 p.m. After a short recess, Charlie and I will convene the annual meeting at 3:45 p.m. This business session typically lasts only a half an hour or so. Your venue for shopping will be the 194,300 square foot hall that adjoins the meeting, in which products from dozens of Berkshire subsidiaries will be for sale. If you don't get your shopping done Friday, stop by while Charlie's talking on Saturday and binge on our bargains. Check the terrific BNSF Railroad layout also. Even though I'm 84, it still excites me. Last year, you did your part as a shopper, and most of our business racked up with record sales in a 9-hour period on Saturday. We sold 1,385 pairs of Justin Boots. That's a pair of every 23 seconds. 13,440 pounds of See's candies, 276 pairs of Will's Lamont work gloves, and 10,000 bottles of Heinz ketchup. Heinz is a new mustard product, so both mustard and ketchup will be available this year. Buy both. Now that we are open for business on Fridays as well, we expect new records in every percent. Brooks, our running shoe company, will again have a special commemorative shoe to offer the meeting. After you purchase a pair, wear them the next day at our third annual Berkshire 5K and 8 a.m. race starting at the Central Link. Full details for participating will be included in the visitor's guide. They'll be sent to you with the credentials for the meeting. Entrants in the race will find themselves running alongside many of Berkshire's managers, directors, and associates. Charlie and I, however, will sleep in. A Geico booth in the shopping area will be staffed by a number of companies' top counselors from around the country. Stop by for a quote. In most cases, Geico will be able to give your shareholders discount, usually 8%. The special offer is permitted by 44 of the 51 jurisdictions in which we operate. One supplemental point, the discount is not additive. If you qualify for another discount, such as available to certain groups, bring the details of your existing insurance and check out your price so we can save many of your real money. Be sure to visit Bookworm. It will carry about 35 books and DVDs, among them a couple of new titles. Last year, many shareholders purchased Max Olson's compilation of Berkshire letters going back to 1965. He has produced an updated edition for the meeting. We also expect to be selling an expensive book commemorating our 50 years. It's currently a work in process, but I expect it to contain a wide variety of historical material, including documents from the 19th century. An attachment to the proxy material that is enclosed with this report explains how you can obtain the credential you will need for admission to both the meeting and other events. Airlines have sometimes jacked the price of your Berkshire weekend. If you are coming from far away, compare the cost of flying to Kansas City versus Omaha. The drive between the two cities, it's about 2.5 hours, and maybe to Kansas City can save you significant money, particularly if you have planned to rent a car in Omaha. The savings for a couple could run to $1,000 or more. Spend that money with us. At Nebraska Furniture Mart, located on a 77-acre site on 72nd Street between Dodge and Pacific, we'll again be having Berkshire weekend discount pricing. Last year, in the week surrounding the meeting, the store did a record $40,481,817 of business. An average week for NFM's Omaha store is about $9 million. To obtain the Berkshire discount at NFM, you must make your purchase between Tuesday, April 28th, and Monday, May 4th, inclusive, and also present your meeting credential. The period special pricing will even apply to the products of several prestigious manufacturers that normally have ironclad rules against discounting, but which in the spirit of our shareholders weekend have made an exception for you. We appreciate your cooperation. NFM is open from 10 a.m. to 9 p.m. Monday through Friday, 10 a.m. to 9:30 p.m. On Saturday, 10 a.m. to 8 p.m. on Sundays. From 5:30 p.m. to 8 p.m. on Saturday, NFM is having a picnic to which you are all invited. At board times, we'll again have two shareholders-only events. The first will be a cocktail reception from 6 p.m. to 9 p.m. on Friday, May 1st. Second, the main gala will be held on Saturday, May 3rd from 9 a.m. to 4 p.m. On Saturday, we will remain open until 6 p.m. In recent years, our 3-day volume has far exceeded our sales. And all December, normally a jeweler's best month, we will have huge crowds at board times throughout the weekend for your convenience. Therefore, shareholder prices will be available from Monday, April 27th through Saturday, May 9th. During that period, please identify yourself as a shareholder by presenting your meeting credentials or brokerage statement that shows you are a Berkshire shareholder. On Saturday, in the mall outside board times, Norman Beck, a remarkable magician from Dallas, will be with their onlookers. Additionally, we will have Bob Hammond and Sharon Osberg, two of the world's top bridge experts, available to play bridge with our shareholders on Sunday afternoon. We'll play them for money. My friend Errol Singh will be in the mall as well on Sunday to take on challenges at table tennis. I met Errol when she was 9 and even I was unable to score a point against her. Now she's sophomore at Princeton, having already represented the United States in the 2012 Olympics. If you don't mind embarrassing yourself, test your skill against her. Begin at 1 p.m. Bill Gates and I will lead off and try to soften her up. Gourds and Piccolos will be again opening exclusively for Berkshire shareholders on Sunday, May 3rd. Both will be serving until 10 p.m. with Goretz opening at 1 p.m. and Piccolos opening at 4 p.m. These restaurants are my favorites, and I will eat at both of them on Sunday evening. Remember to make reservation at Goretz. Call 402-551-3733 on April 1st, but not before. For Piccolos, call 402-346-2865. At Piccolos, order a giant root beer for float dessert, only since you get the small one. We'll again have the same three financial and journalists lead the question and answer period at the meeting, asking Charlie and me questions that shareholders have submitted to them by email. The journalists and their email address are Carol Loomis, who retired last year after 60 years in fortune, but remains an expert in business financial matters, and who may be emailed at loomisbrk@gmail.com, Becky Quick of KNBC at BerkshireQuestions@CNBC.com, and Andrew Ross Sorkin of the New York Times at arsorkin@nytimes.com. For the questions submitted, each journalist will choose the 6 or he or she decides are the most interesting and important. The journalists have told me your question has the best chance of being selected if you keep it concise, avoid sending in at the last moment, make it Berkshire related, and include no more than 2 questions in any email you send them. In your email, let the journalists know if you would like your name mentioned if your question is asked. We will also have a panel of 3 analysts who follow Berkshire. This year, insurance specialist Gary Ransom of Dowling Partners. Questions that deal with our non-insurance operations will come from Jonathan Brandt of Rain, Cuniff and Goldfarb, and Greg Warren of Morningstar. Our job is that the analysts and journalists will ask questions that add our owners' understanding and knowledge of investment. Neither Charlie nor I will get so much a clue about the questions headed our way. Sometimes will be tough, for sure, and that's the way we like it. All told, we expected at least 54 questions, which will allow for 6 from each analyst and journalist, and for 18 from the audience. Last year, we had 62 in total. The questioners from the audience will be chosen by means of 11 drawings that will take place at 8:15 a.m. on the morning of the annual meeting. Each of the 11 microphones installed in the arena main overflow room will host speaker drawing. While on the subject of our owners gaining knowledge, let me remind you that Charlie and I believe all shareholders should simultaneously have access to new information that Berkshire releases and should also have adequate time to analyze it. That's why we try to issue financial data late on Fridays or early on Saturdays, and why our annual meetings is always held on Saturday. We do not talk one-on-one to large institutional investors and analysts, treating them instead as we do all other shareholders. We get terrific help at meeting time from literally tons of Omaha residents and businesses who want you to enjoy yourselves this year. Because we expect record attendance, we have worried about shortage of hotel rooms. To deal with that impossible problem, Airbnb is making special effort to obtain listings from the period around meeting time, and it's like to have a wide array of combinations to offer. Airbnb service may be especially helpful to shareholders who expect to spend only a single night in Omaha and are aware of the last year's a few hotels required guests to pay for a minimum of 3 nights. That gets expensive. Those people on a tight budget should check out Airbnb website. For a good reason, I regularly extol the accomplishment of our operating managers. They are truly all-stars who run their businesses as if they were the only asset owned by their families. I believe the mindset of our managers also to be as shareholder-oriented as can be found in the universe of large publicly owned companies. Most of our managers have no financial need to work. The joy of hitting business home runs means as much to them as their paycheck. Equally important, however, are the 24 men and women who work with me at our corporate office. This group efficiently deals with a multitude of FTC and other regulatory requirements, files a 24,100-page federal income tax return, and oversees oversees the filing of 3,400 state tax returns, respond to countless shareholders and media inquiries, gets out the annual report, prepares for the country's largest annual meeting, coordinates the board's activities, and the list goes on and on. They handle all of these business tasks cheerfully and with a believable efficiency, making my life easy and pleasant. Their efforts go beyond activities strictly related to Berkshire. Last year, they dealt with 14 universities, selected from 200 applicants who sent students to Omaha for a Q&A day with me. They also handle all kinds of requests that I receive, arrange my travel, and even get me hamburger and french fries smothered in ice ketchup. Of course, for lunch, no CEO has it better. I truly do feel like tap dancing at work every day. Last year, for the annual report, we dropped our 48-year-old no pictures policy, hosted them a lot flexible, and ran a photo of a remarkable home office crew that was taken at Christmas lunch. I didn't warn the gang of the public exposure they would receive, so they didn't have on their Sunday's best. This year was a different story. On facing a page, you will see what the group looks like when they think someone will be noticing. However, they address their performance is mind-boggling. Come meet them on May 2nd and enjoy our Woodstock for Capitalist. February 27, 2015, Warren E. Buffett, Chairman of the Board. Berkshire Hathaway Incorporated Acquisition Criteria. We are eager to hear from principals or representatives about businesses that meet all of the following criteria. Large purchase, at least $75 million of pre-tax earnings unless the business will fit into one of their existing units. 2. Demonstrate consistent earning power. Future projections are of no interest to us, nor our turnaround situations. 3. Business earning good returns on equity while employing little or no debt. 4. Management in place. We can supply it. 5. Simple businesses. If there's a lot of technology, we won't understand it. An offering price. We don't want to waste our time or that of the seller by talking, even preliminary about transaction when the price is unknown. The larger the company, the greater will be our interest. We would like to make an acquisition the $5 to $20 billion range. We are not interested, however, in receiving suggestions about purchases we might make in the general stock market. We will not engage in friendly takeovers. We can promise complete confidentiality and a very fast answer, customarily within 5 minutes, as to whether we're interested. We prefer to buy for cash, but will consider issuing stock when we receive as much as intrinsic business value as we give. We don't participate in auctions. Charlie and I frequently get approached by acquisitions that don't come close to meeting our tests. We found that if you advertise an interest in buying collies, a lot of people will call hoping to sell you their Cocker Spaniels. A line from a country song express our feelings about new ventures, turnouts, or auction-like sales. When the phone don't ring, you'll know it's me. Berkshire, past, present, and future in the beginning. On May 6, 1964, Berkshire Hathaway, then run by a man named Seabury Stanton, sent a letter to shareholders offering to buy 225,000 shares at stock for $11.375 per share. I had expected the letter. I was surprised by the price. Berkshire then had 1,583,680 shares outstanding. About 7% of these were owned by Buffett Partnership Limited, BPL, an investing entity that I managed, in which I had virtually all of my net worth. Shortly before the tender offer was mailed, Stanton had asked me what price BPL would sell its holdings. I answered $11.50, and he said, "Fine, we have a deal." Then came Berkshire's letter offering an eighth of a point less. I bristled at Stanton's behavior and didn't tender. That was monumentally a stupid decision. Berkshire was an endorsement textile manufacturer mired in a terrible business. The industry in which it operated was heading south, both metaphorically and physically, and Berkshire, for a variety of reasons, was unable to change course. That was true even though the industry's problem had long been widely understood. Berkshire's own board meeting of July 29, 1954 laid out the grim facts. The textile industry in New England had started going out of business for 40 years ago. During the war years, this trend was stopped. The trend was continued until supply and demand have been balanced. About a year after that board meeting, Berkshire's fine spinning associates in Hathaway Manufacturing, both with roots in the 19th century, joined forces, taking the name we read today. With its 14 plants and 10,000 employees, the merged company became the giant of New England textiles, with the two managements viewed as a merger agreement, however, soon morphed into a suicide pact. During the 7 years following the consolidation, Berkshire operated at an overall loss, and its net worth shrunk by 37%. Meanwhile, the company closed 9 plants, sometimes using the liquidation proceeds to repurchase shares, and that pattern caught my attention. I purchased BPL's fair share of Berkshire in December 1962, anticipating more closings and more repurchases. The stock was then selling for $7.50, a wide discount for Berkshire working capital of $10.25 and book value of $20.20. Buying the stock at the price was like picking up a discarded cigar butt that had one puff remaining in it. Though the stub might be ugly and soggy, the puff would be free. Once that momentary pleasure was enjoyed, however, no more could be expected. Berkshire thereafter stuck to the script. It soon closed down another 2 plants in May 1964. Moves set out to repurchase shares with the shutdown proceeds. The price at the time offered was 50% above the cost of our original purchases. There it was, my free puff just waiting for me, after which I could look elsewhere for other discarded butts. buts. Instead, irritated by Stanton's chiseling, I ignored his offer and began to aggressively buy more Berkshire's shares. By April 1965, BPL owned 392,630 shares out of 1,017,547, then outstanding. At an early May board meeting, we formally took control of the company. Though through Seabury and my childish behavior, after all, what was an eighth point to either of us? He lost his job and I found myself with more than 25% of BPL's capital invested in a terrible business about which I knew very little. I became the dog who caught the car. Because of Berkshire's operating losses and their share purchase net worth at the end of fiscal 1964 had fallen to $22 million from $55 million at the time of the 1955 merger, the full $22 million was required by the textile operation. The company had no excess cash and owed its bank $2.5 million. Berkshire's 1964 annual report is reproduced on pages 130 to 142. For the time I got lucky, Berkshire immediately enjoyed 2 years of good operating conditions. Better yet, its earnings in those years were free in income tax because it possessed a large loss carry forward that had arisen from the disastrous results in earlier years. Then the honeymoon ended. During the 18 years following 1966, we struggled unremittingly with the textile business, all to no avail. But stupidity has its limits. In 1985, I finally threw in the towel and closed the operation. Undeterred by my first mistakes of committing much of BPL's resources to the dyeing business, I quickly compounded the error. Indeed, my second blunder was far more serious than the first, eventually becoming the most costly in my career. Early in 1967, I had a Berkshire pay $8.6 million but to buy National Indemnity Company, NICO, a small but promising Omaha-based insurer. A tiny sister company was also included in the deal. Insurance was a sweet spot. I understood and liked the industry. Jack Ringwald, the owner of NICO, was a longtime friend who wanted to sell to me. Me personally, in no way was this offer intended for Berkshire. So why did I purchase NICO for Berkshire rather than for BPL? I've had 48 years to think about that question, and I have yet to come up with a good answer. I simply made a colossal mistake. If BPL had been the purchaser, my partner and I would have owned 100% of a fine business that didn't form the base for building the company Berkshire has become. Moreover, our growth would not have been impeded for nearly 2 decades by the unproductive funds imprisoned in the textile operation. Finally, our subsequent acquisitions would have been owned in their entirety by my partners and me, rather than being 39% owned by the luggage shareholders of Berkshire, to whom we had no obligation. Despite these facts staring me in the face, I opted to marry 100% an excellent business, and I CEO the 61% owned terrible business, Berkshire Hathaway, a decision that eventually diverted $100 billion or so from BPL partners to a collection of strangers. One more confession and then I'll go on to more pleasant topics. Can you believe that in 1975, I bought Wambeck Mills, another New England textile company? Of course, the purchase price was a bargain based on the assets we received and the projected synergies with Berkshire's existing textile business. Nevertheless, surprise, surprise, Wambeck was a disaster, with the mill having to be closed down not many years later. And now some good news. The northern textile industry is finally extinct. You need no longer panic if you hear that I've spotted wandering around New England. Charlie straightens me out. My cigar butt strategy worked very well while I was managing small sums. Indeed, the many dozens of free puffs I obtained in the 1950s made that decade by far the best of my life for both relative and absolute investment performance. Even then, however, I made a few exceptions to cigar butts, the most important being Geico, thanks to a 1951 conversation I had with Lorimer Davidson, a wonderful man who later became CEO of the company. I learned that Geico was a terrific business and promptly put 65% of my $9,800 net worth into its shares. Most of my gains in those early years, though, came from my investment in mediocre companies that traded at bargain prices. Ben Graham had taught me that technique and it worked. But a major weakness in this approach gradually became apparent. Cigarette butt investing was scalably only a point with large sums that could never work well. In addition, though marginal business purchases at cheap price may be attractive as short-term investment, they are the wrong foundation on which to build a large and enduring enterprise. Selecting a marriage partner clearly requires more demanding criteria than does dating. Berkshire, it should be noted, would have been a highly satisfactory date if we had taken Seabury Stanton's $11,375 offer for shares. BPL's weighted annual return on its Berkshire investment would have been about 40%. It took Charlie Munger to break my cigar butt habit and set the course for building a business that could combine huge size with satisfactory profits. Charlie had grown up a few hundred feet from where I now live, and as a youth had worked as I did in my father's grocery store. Nevertheless, it was 1959 before I met Charlie long after he had left Omaha to make Los Angeles his home. I was in 28 and he was 35. The Omaha doctor who introduced us predicted that we would hit off, and we did. If you attended our annual meetings, you know Charlie's wide-ranging brilliance. A prodigious memory and some firm opinions. I'm not exactly wishy-washy myself, and we sometimes don't agree. In 56 years, however, we've never had an argument. When we differ, Charlie usually ends the conversation by saying, "Warren, think it over, and you'll agree with me because you're smart and I'm right." What most of you do not know about Charlie's architecture is among his passions. Though he began his career as a practicing lawyer, with this time billed at $15 per hour. Charlie made his first real money in his 30s by designing and building 5 apartment projects near Los Angeles. Concurrently, he designed the house that he lives in today. Some 55 years later, like me, Charlie can't be budged if he's happy in his surroundings. In recent years, Charlie has designed a large dorm complex at Stanford University of Michigan. Today, at age 91, is working on another major project. From my perspective, though, Charlie's most important architectural feat was the design of today's Berkshire. The blueprint he gave me was simple. Forget what you know about buying fair business at wonderful prices. Instead, buy wonderful business at fair prices. Altering my behavior is not an easy task, asked my family. I had enjoyed reasonable success without Charlie's input, so why should I listen to a lawyer who had never spent a day in business school when I had attended 3? But Charlie never tired of repeating his maxims about business and investing to me, and his logic was irrefutable. Consequently, Berkshire has been built to Charlie's blueprint. My role has been that of general contractor with CEOs of Berkshire subsidiaries through their real work as subcontractors. The year 1972 was a turning point for Berkshire, though not with occasional backsliding on my part. Remember my 1975 purchase of Wambeck? We had the opportunity then to buy See's Candies for Blue Chip Stamps, a company in which Charlie and I and Berkshire had major stakes and which was later merged into Berkshire. See's was a legendary West Coast manufacturing and retailer of box chocolates, then annually earning about $4 million pre-tax while utilizing only $8 million of net tangible assets. Moreover, the company had a huge asset that did not appear on its balance sheet, a broad and durable competitive advantage that gave it significant pricing power, and a strength was virtually certain to give See's major gains in earnings over time. Better yet, these materialized with only minor amounts of incremental investment. In other words, See's could be expected to gush cash for decades to come. The family controlling See's wanted $30 million for the business, and Charlie rightly said it was worth that much, but I didn't want to pay more than $25 million, and wasn't all that enthusiastic even at the figure, a price that was 3 times the tangible assets made me gulp. My misguided caution could have scuttled a terrific purchase, but luckily the sellers decided to take our $25 million bid. To date, See's has earned $1.9 billion pre-tax, with its growth having required added investment of only $40 million. See's has thus been able to distribute huge sums that have helped Berkshire buy other businesses that in turn have themselves produced large distributable profits and vision rabbits breeding. Additionally, through watching See's in action, I gained a business education about the value of powerful brains that opened my eyes to many other profitable investments. Even with Charlie's blueprint, I have made plenty of mistakes since Wambeck. The most gruesome was Dexter Shoe. When we purchased the company in 1993, it had a terrific record, and though it looked to me like a cigar butt, its competitive strengths, however, were soon to evaporate because of the foreign competition, and I simply didn't see that coming. Consequently, Berkshire paid $433 million for the Dexter, and rather promptly, its value went to zero. GWP accounting, however, doesn't come close to recording the magnitude of my error. The fact that I gave Berkshire stock to the sellers of Dexter rather than cash, and the shares I used for the purchase are now worth about $5.7 billion. As a financial disaster, this one deserves a spot in the Guinness Book of World Records. Several of my subsequent errors also involved the use of Berkshire shares to purchase businesses whose earnings were destined to simply limp along. Mistakes of that kind are deadly. Trading shares of a wonderful business, which Berkshire mostly certainly is, for ownership of a so-so business, irreparably destroys value. We've also suffered financially when this mistake has been committed by companies whose shares Berkshire has owned, with the errors sometimes occurring while I was serving as a director. Too often, CEOs seem blind to an elementary reality. The intrinsic value of the shares you give in an acquisition must not be greater than the intrinsic value of the business you receive. I've yet to see an investment banker quantify this all-important math when he is presenting a stock-for-stock deal to the board of a potential acquirer. Instead, the banker's focus will be on describing customary premiums to market price that are currently being paid for acquisition, and absolutely assigning a way to evaluate the attractiveness of an acquisition or whether the deal will increase the acquirer's earnings per share, which in itself should be far from determinative. In striving to achieve the desired per share number, as painting CEO and his helpers will often conjure fanciful synergies. As a director of 19 companies over the years, I've never heard the synergies mentioned, though I've witnessed plenty of these once the deals have closed. Postmortems of acquisition in which reality is honestly compared to the original projections are rare in American boardrooms. They should instead be standard practice. I can promise you that long after I'm gone, Berkshire's CEO and board will carefully make intrinsic value calculations before issuing shares in any acquisition. You can't get rich trading a $100 bill for 8 cents, even if your advisor has handed you an expensive fairness opinion endorsing that swap. Overall, Berkshire's acquisitions have worked out well and very well in the case of a few large ones too. So too have our investments in marketable securities. The latter are always valued on our balance sheet at their market prices, so any gains, including those unrealized, are immediately reflected in our net worth, but the business we buy outright are never revalued upward on our balance sheet, even when we could sell them for many billions of dollars more than their carrying value. The unrecorded gains in the value of Berkshire subsidiaries have become huge, with these growing at a particularly fast pace in the last decade. Listening to Charlie has paid off. Berkshire today. Berkshire is now a sprawling conglomerate, constantly trying to sprawl further. Conglomerates, it should be acknowledged, have a terrible reputation with investors, and they should deserve it. Let me first explain why they are in the doghouse, and then I will go on to describe why the conglomerate form brings huge and enduring advantages to Berkshire. Since I entered the business world, conglomerates have enjoyed several periods of extreme popularity, the silliest of which occurred in the late 1960s. The drill for conglomerate CEOs then was simple: by personality, promotion, or dubious accounting, and often by all three. These managers drove a fledgling conglomerate stock to say 20 times earnings and then issued shares as fast as possible to acquire another business selling at 10 or so times earnings. They immediately applied pooling accounting to the acquisition, which, with not a dime's worth of change in the underlying business, automatically increased per share earnings and used the rise as proof of managerial genius. They next explained to investors that this sort of talent justified the maintenance or even the enhancement of the acquirer's PE multiple, and finally they promised to endlessly repeat this procedure and thereby create ever-increasing per share earnings. Wall Street love affair with this hocus-pocus intensified as the 1960s rolled by. The street's denizens are always ready to suspend disbelief when the dubious maneuvers are used to manufacturers rising per share earnings, particularly if these acrobatics produce mergers that generate huge fees for investment bankers. Auditors willingly sprinkle their holy water on the conglomerates, accounting and sometimes even made suggestions in house to how to further juice to the numbers. For many gushers of the easy money washed away ethical sensitivities, since the per share earnings gains of an expanding conglomerate came from the exploiting PE differences that CEO had to search for business selling at low multiples of earnings. These courses were characteristically mediocre business with poor long-term prospects. This incentive to bottom fish usually led to conglomerates' collection of underlying business becoming more and more junky. That mattered little to investors. It was a deal velocity in pulling counting. They looked for increased earnings. The resulting firestorm for merger activity was fanned by an adoring press. Companies such as ITT, Lit-On Industries, Gulf and Western, and LTV were lionized, and their CEOs became celebrities. These once famous conglomerates are now long gone. As Yogi Berra said, every Napoleon misses Watergate. Back then, accounting shenanigans of all sorts, many of them ridiculous or transparent, were excused or overlooked. Indeed, having an accounting wizard at the helm of an expanding conglomerate was viewed as a huge plus. Shareholders in those instances could be sure that reported earnings would never disappoint, no matter how bad the operating realities of the business might become. In the late 1960s, I attended a meeting at which an acquisitive CEO bragged of his bold imaginative accounting. Most of the analysts listening responded with approving nods, seeing themselves have a found manager whose forecasts were certain to be met, whatever the business results might be. Eventually, however, the clock struck 12 and everything turned to pumpkins and mice, and once again it became evident that the business models based on the serial issuance of overpriced shares, just like chain letter models, most assuredly redistribute wealth, but in no way create it. Both phenomena nevertheless periodically blossom in our country. They are ever re-promoter stream, though often they appear in a carefully crafted disguise. The ending is always the same. Money flows from the gullible to the fraudster, and with stocks, unlike chain letters to the sums hijack can be staggering. At both People and Berkshire, we have never invested in companies that are hell-bent on issuing shares. That behavior is one of the most surest indicators of a promotion-minded management, weak accounting, a stock that is overpriced, and all too often outright dishonesty. So what do Charlie and I find so attractive about Berkshire's conglomerate structure? To put the case simply, if the conglomerate form is used judicially, it is an ideal structure for maximizing long-term capital growth. One of the heralded For exclusive capitalism is that it efficiently allocates funds. The argument is that markets will direct investment to promising business and deny to those to wither. That is true with all its excess market-driven allocation of capital, usually far superior to any alternative. Nevertheless, there are often obstacles to the rational movement of capital, as those 1954 Berkshire minutes made clear. Capital withdrawals within the textile industry that should have been obvious were delayed for decades because of the vain hopes of self-interest of management. Indeed, I myself delayed abandoning our obsolete textile mills far too long. A CEO with capital employed in declining operations seldom looks to massively redeploy that capital in internal related activities. A move of that kind would usually require that long-time associates be fired and mistakes be admitted. Moreover, it's unlikely that CEO would be manager you would wish to handle a redeployment job even if he or she was inclined to undertake it. At the shareholder level, taxes and frictional costs weigh heavily on individual investors when they attempt to allocate capital among business and industries. Even tax-free institutional investors face major costs as they move capital because they usually need intermediaries to do this job. A lot of mouths at expensive taste and clamor to be fed, among them investment bankers, accountants, consultants, lawyers, and such capital allocators as leveraged buyout operators. Money shufflers don't come cheap. In contrast, a conglomerate such as Berkshire is perfectly positioned to allocate capital rationally at a minimal cost. Of course, from itself is no guarantee of success. We had made plenty of mistakes and we will make more. Our structural advantages, however, are formidable. At Berkshire, we can, without incurring taxes or much more in the way of other costs, move huge sums from business and have limited opportunities for incremental investment to other sectors with greater promise. Moreover, we are free of historical biases created by lifelong association with a given industry and are not subject for pressures from colleagues having vested interest in maintaining the status quo. That's important. If horses had controlled investment decisions, there would have been no auto industry. Another major advantage we possess is the ability to buy pieces of wonderful business, aka common stocks. That's not a course of action open to most managements. Over history, this strategic alternative has proved to be very helpful. A broad range of options always sharpens decision making. The business we are offered by the stock market every day in small pieces, to be sure, are often far more attractive than the business we are concurrently being offered in its entirety. Additionally, the gains we've realized from marketable securities have helped us make certain large acquisitions that the rest have been beyond our financial capabilities. In effect, the world is Berkshire's oyster, a world offering us a range of opportunities far beyond those realistically open to most companies. We are limited, of course, to business whose economic prospects we can evaluate, and that's a serious limitation. Charlie and I have no idea what great many companies will look like in 10 years from now, but that limitation is much smaller than the born by an executive whose experience has been confined to a single industry. On top of that, we can profitably scale to a far larger size than the many businesses that are constrained by the limited potential of the single industry in which they operate. I mentioned earlier that See's Candies had produced a huge earnings compared to its modest capital requirements. We would have loved, of course, to intelligently use those funds to expand our candy operation, but our many attempts to do so were largely futile. So with incurring tax and inefficiencies or friction costs, we have used the excess funds generated by See's to help purchase other business. If See's has remained a standalone company, its earnings would have had to be distributed to investors to redeploy sometimes after being heavily depleted by large taxes and almost always by significant frictional and agency cost. Berkshire has one further advantage that has become increasingly important over the years. We are now the home of choice for the owners and managers of our many outstanding businesses. Families that own successful businesses have multiple options when they contemplate sale. Frequently, the best decision is to do nothing. There are worse things in life than having prosperous business that one understands well, but sitting tight is seldom recommended by Wall Street. Don't ask a barber whether you need a haircut. When one part of a family wishes to sell while others wish to continue, a public offering often makes sense, but when owners wish to cash out entirely, they usually consider one of two paths. The first sale to a competitor who is salivating at the possibility of bringing synergies from the combining of the two companies. This buyer invariably contemplates getting rid of large numbers of the seller's associates. Severe people have helped the owner build his business. A caring owner, however, there are plenty of them, usually does not want to leave his longtime associates tightly singing the old country song, "She got the golden mine, I got the shaft." The second choice for sellers as a Wall Street buyer. For some years, these purchasers accurately called themselves leveraged buyout firms. When the term got bad name in the early 1990s, remember RJR and the Barbarians at the Gate? These buyers hastily labeled themselves private equity. The name may have changed, but that was all. Equity is dramatically reduced, and that is piled on in virtually all private equity purchases. Indeed, the amount that private equity purchase offers that seller is in part determined by the buyer assessing the maximum amount of debt that can be placed on the acquired company. Later, if things go well and the equity begins to build, leverage buyout shops will often seek to leverage with new borrowings. They then typically use part of the proceeds to pay huge dividends that drive equity sharply downward, sometimes even to a negative figure. In truth, equity is a dirty word for many private equity buyers. What they love is debt. And because debt is currently so inexpensive, these buyers can frequently pay top dollar. Later, the business will be resold off another leveraged buyer. In effect, the business becomes a piece of merchandise. Berkshire offers a third choice to the business owner who wishes to sell a permanent home in which the company's people and culture will be retained, though occasionally management changes will be needed. Beyond that, any business will require dramatically increase its financial strength and ability to grow. Its days of dealing with banks and Wall Street analysts are also forever ended. Some sellers don't care about these matters, but when sellers do, Berkshire does not have a lot of competition. Sometimes pundits propose that Berkshire spin off certain of its business. These suggestions make no sense. Our companies are worth more than as part of Berkshire than as separate entities. One reason is the ability to move funds between business or into new ventures instantly and without tax. In addition, certain costs duplicate themselves and fall apart, or if operations are separated. Here's the most obvious example. Berkshire incurred nominal costs for its single board of directors, where are dozens of subsidiaries to be split off. The overall cost for directors would soar, so too would regulatory and administration expenditures. Finally, there are sometimes important tax efficiencies for subsidiary A because we own subsidiary B, where, for example, certain tax credits that are available to our utilities are currently realizable only because we generate huge amounts of taxable income at other Berkshire operations. That gives us Berkshire Hathaway Energy a major advantage over most public utility companies in developing wind and solar projects. Investment bankers being paid as they are for action constantly urge requires to pay 20% to 50% premiums over market price for publicly held business. The bankers tell the buyer that the premiums justified for control value and for the wonderful things that are going to happen once the acquired CEO takes charge. One acquisition-hungry manager will challenge that assertion. A few years later, bankers beer and straight faces again appear and just as earnestly urge spinning off the earlier acquisition in order to unlock shareholder value. Spin-offs, of course, strip the owning company of its purported control value without any compensating payment. The bankers explained that the spun-off company will flourish because its management will be more entrepreneurial, having been freed from the smothering bureaucracy of the parent company. So much for the talented CEO we met earlier. And the divesting company later wishes to require the spun-off operation. It presumably would again be urged by bankers to pay a hefty control premium for the privilege. Mental flexibility of this sort by banking fraternity has prompted the saying that fees too often lead to transactions rather than transactions leading to fees. It is possible, of course, that someday a spin-off or sale at Berkshire would be required by regulators. Berkshire carried out such a spin-off in 1979 when the new regulations from bank holdings companies forced us to divest a bank we owned in Rockford, Illinois. Voluntary spin-offs, though, make no sense for us. We would lose control, value, capital allocation flexibility, and in some cases important tax advantage. Just the CEO who bluntly run our subsidiaries now would have difficulty in being as effective if running a spun-off operation given the operating and financial advantages derived from Berkshire's ownership. Moreover, the parent and the spun-off operations, when separated, will likely incur moderately greater costs than existed when they were combined. Before I depart the subject of spin-offs, let's look at a lesson to be learned from a conglomerate mentioned earlier, LTV. I'll summarize here, but those who enjoy a good financial story should read the piece about Jimmy Ling that ran the October 1982 issue of D Magazine. Look it up on the internet to show a lot of corporate razzle-dazzle. Ling had taken LTV from sales of only $36 million in 1965 to number 14 on the Fortune 500 list. Just 2 years later, Ling, it should be noted, had never displayed any managerial skills, but Charlie told me long ago to never underestimate the man who overestimates himself, and Ling had no peer in that respect. Ling's strategy, which he labeled Project Redeployment, was to buy a large company and then partially spin off its various divisions. In LTV's 1966 annual report, he explained the magic that would follow. Most importantly, acquisitions must meet the test of the 2 plus 2 equals 5 or 6 formula. The press, the public, and Wall Street loved this sort of talk. The 1967 Ling bought Wilson and Company, a huge meat packer, and that also had interest in golf equipment and pharmaceuticals. Soon after, he split the parent into 3 businesses, Wilson and Company, Meatpacking, Wilson Sporting Goods, and Wilson Pharmaceuticals, each of which has to be partially spun off. These companies quickly became known on Wall Street as Meatball, Golf Ball, and Goofball. Soon thereafter, it became clear that like in Icarus, Ling had flown too close to the sun. By the early 1970s, Ling's empire was melting, and he himself had been spun off from LTV. That is fired. Periodically, financial markets will become divorced from reality. You can count on that. More Jimmy Lings will appear. They will look and sound authoritative. The press will hang on their every word. Bankers will fight for their business. What they are saying will recently have worked. Their early followers will be feeling very clear. Our suggestion, whatever the line, never forget that 2 plus 2 will always equals 4. And when someone tells you how old-fashioned that math is, zip up your wallet, take a vacation, and come back in a few years to buy stock at cheap prices. Today, Berkshire possesses one, an unmatched collection of business, most of them now enjoying favorable economic prospects. Two, a cadre of outstanding managers who, with a few exceptions, are unusually devoted to both the subsidiary they operate into Berkshire. Three, an extraordinary diversity of earnings, premier financial strength, and notions of liquidity that will maintain under all circumstances. Four, a first choice ranking among many owners and managers who are contemplating sale of their business. And five, in a point related to the preceding item, a culture distinctive in many ways from that most large companies that we have worked 50 years to develop, but that is now rock solid. These strengths provide us wonderful foundation on which to build the next 50 years of Berkshire. Now let's take a look at the road ahead. Bear in mind that if I had attempted 50 years ago to gauge what was coming, certain my predictions would have been far off the mark. Without warning, I will tell you that what I would say to my family today if they asked me about Berkshire's future. First and definitely foremost, I believe that the chance of permanent capital loss for patient Berkshire shareholders is as low as that can be found among single company investments. That's because their per share intrinsic value, business value, is almost certain to invest over time. This true prediction comes home, however, with an important caution. If an investor's entry point into Berkshire stock is unusually high, at price say approaching double book value, which Berkshire shares have occasionally reached, it may well be many years before the investors can realize a profit. In other words, a sound investment can morph into a rash speculation if it's bought at an elevated price. Berkshire is not exempt from its truth. Purchases of Berkshire that investors make at a price modestly above the level at which the company would purchase its shares, however, should produce gains within a reasonable period of time. Berkshire's directors will only authorize the purchase at a price they believe to be well below intrinsic value. In our view, that is an essential criterion for a purchase that is often ignored by other managements. For those investors who plan to sell within a year or two after purchase, I can offer no assurances whatever the entry price. Movements of the general stock market during such abbreviated periods will likely be far more important in determining results than the concomitant change in intrinsic value of the Berkshire shares. As Ben Graham said many decades ago, in the short term, the market is a voting machine, in the long run, the index is a weighing machine. Occasionally, the voting decision of investors, amateurs, and professionals alike border on lunacy. Since I know of no way reliably predict market movements, I recommend that you purchase Berkshire shares only if you expect to hold them for at least 5 years. Those who seek short-term profit should look elsewhere. Another warning, Berkshire shares should not be purchased with borrowed money. There have been 3 times since 1965 when our stock had fallen about 50% from its high point. Someday something close to this kind of drop will happen again, and no one knows when Berkshire will almost certainly be a satisfactory holding for investors. But it could well be a disaster choice for speculators employing leverage. I believe the chance of any event causing Berkshire to experience financial problems is essentially zero. We'll always be prepared for the 1,000-year flood. In fact, if it occurs, we will be selling life jackets and prepared. Berkshire played an important role as a first responder during the 2008-2009 meltdown, and we have since more than doubled the strength of our balance sheet in our earnings potential. Your company is the Gibraltar of American business. One remains so. Financial staying power requires a company to maintain 3 strengths under all circumstances. 1, a large and reliable stream of earnings. 2, massive liquid assets. And 3, no significant near-term cash requirements. Ignoring that last necessity is what usually leads companies to experience unexpected problems. Too often CEOs of profitable companies feel they will always be able to refund maturing obligations, however large these are. In 2008-2009, many management learned how perilous that mindset can be. Here's how we will always stand on the 3 essentials. First, our earnings stream is huge and comes from a vast array of businesses. Our shareholders now own many large companies that have durable competitive advantage, and we will acquire more those in the future. Either diversification assures Berkshire continued profitability even if a catastrophe causes insurance losses that far exceed any previously experienced. Next up is cash. At a healthy business, cash is sometimes thought of as something to be minimized as an unproductive asset that acts as a drag on such markets that return on equity. Cash, though, is to a business as oxygen as to an individual. Never thought about when it is present, the only thing in mind when it is absent. American business provided a case study of that in 2008, September of that year. Many prosperous companies suddenly wondered whether their checks would bounce in the days ahead. Overnight, the financial oxygen disappeared. At Berkshire, our breathing went uninterrupted. Indeed, a 3-week period spanning late September and early October, we supplied $15.6 billion of fresh money to American businesses. We could do that because we always maintain at least $20 billion and usually far more in cash equivalents. By that, we mean use treasury bills, not other substitutes for cash that are claimed to deliver the liquidity and actually do so except when it's truly needed. When bills come due Only cash as legal tender, don't leave home without it. Finally, getting into our third point, we will never engage in operating or investment practices that can result in sudden demands for large sums. That means we will not expose Berkshire to short-term debt maturity side nor enter into derivative contracts or other business arrangements that could require large collateral calls. Some year became a party to certain derivative contracts that we believe were significantly mispriced and held only minor collateral requirements. These have proved to be quite profitable recently. However, newly written derivative contracts have required full collateralization and that enter our interest in derivatives regardless of what profit potential they might offer. We have not for some years written these contracts except for a few needed for operational purposes that are utility businesses. Moreover, we will not write insurance contracts that give us policyholders the right to cash out at their option. Many life insurance products contain redemption features that make them susceptible to run in times of extreme panic. Contracts that sort, however, do not exist in property casualty world that we inhabit. If our premium volume should shrink, our float would decline, but only at a very slow pace. The reason for our conservatism, which may impress some people as extreme, is that it is entirely predictable that people occasionally panic, but not all predictable when this will happen. Though practically all days are relatively uneventful, tomorrow is always uncertain. I've held no special branch on December 6, 1941, or September 10, 2001, and if you can't predict what tomorrow will bring, you must be prepared for whatever it does. A CEO who is 64 and plans to retire at 65 may have his own special calculus in evaluating risk. They have only a tiny chance of happening in a given year. He may in fact be right 99% of the time. Those odds, however, hold no appeal for us. We'll never play financial Russian roulette with the funds you've entrusted to us, even if the metaphorical gun has 100 chambers and only one bullet. In our view, it is madness to risk losing what you need and pursuing what you simply desire. Despite our conservatism, I think we will be able to every year to build the underlying per share earning power of Berkshire. That does not mean operating earnings will increase each year. From it, the used economy will ebb and flow, though mostly flow, and when it weakens, so will our current earnings, but we will continue to achieve organic gains, make bolt-on acquisitions, and enter new fields. I believe, therefore, that Berkshire will annually add to its underlying earning power. In some years, the gain will be substantial, and other times they will be minor. Markets, competition, chance will determine when opportunities come our way. Though, at all, Berkshire will keep moving forward, powered by the array of solid business we now possess, and new companies will purchase in most years. Moreover, our country's economy will provide strong tailwind for business. We are blessed to have the United States as our home field. The bad news is that Berkshire's long-term gains measured by percentage, not by dollars, cannot be dramatic and will not come close to those achieved in the past 50 years. The numbers have become too big. I think Berkshire will outperform the average American company, but our advantage, if any, won't be great. Eventually, probably between 10 and 20 years from now, Berkshire's earnings and capital resources will reach a level that will not allow management to intelligently reinvest all of the company's earnings. At that time, our directors will need to determine whether the best method to distribute the excess earnings is through dividends and share purchases, or both. If Berkshire shares are selling below intrinsic business value, massive repurchase will almost certainly be the best choice. You can be comfortable that your directors will make the right decision. No company will be more shareholder-minded than Berkshire. For more than 30 years, we have annually reaffirmed our shareholder principles, see page 117, always leading off with, although our form is corporate, our attitude is partnership. This covenant with you is etched in stone. We have an extraordinarily knowledgeable and business-oriented board of directors ready to carry out that promise of partnership. None took the job for the money, an arrangement almost non-existent elsewhere. Our directors are paid only token fees. They receive their rewards instead of true ownership of Berkshire shares, and the satisfaction that comes from being good stewards of an important enterprise. The shares that they and their families own, which in many cases are worth very substantial sums, were purchased in the market rather than materializing through opinions or options or grants. In addition, unlike almost all other sizable public companies, we carry no directors and officers like ability insurance. At Berkshire, directors walk in your shoes. To further ensure continuation of our culture, I've suggested that my son Howard succeed me as a non-executive chairman. Now, my only reason for this wish is to make change easier. If the wrong CEO should ever be employed in the there occurs a need for the chairman to move forcefully. I can assure you that this problem, very low probability of rising at Berkshire, likely as though as any public company in my service on the boards of 19 public companies. However, I've seen how hard it is to replace a mediocre CEO that if the person is also chairman, the deed usually gets done, but almost always very late. If elected, Howard will receive no pay and will spend no time at the job other than that required of all directors. He will simply be a safety valve to whom any director can go if he or she has concern about CEO and wishes to learn, if other directors express doubts as well. Should multiple directors be apprehensive, Howard Sherman said will allow the matter to be promptly and properly addressed. Choosing the right CEO is all important as a subject matter that commends much time at the Berkshire board meetings. Managing Berkshire is primarily a job of capital allocation, coupled with the selection and retention of outstanding managers, the captain, are operating subsidiaries. Obviously, each job also requires the replacement of subsidiary CEO when that is called for. These duties require the Berkshire CEO to be a rational, calm, and decisive individual who has a broad understanding of business and good insights into human behavior. It is important as well as that he knows his limits. As Tom Watson, senior of ABM, said, "I'm no genius, but I'm smart at spots and I stay around those spots." Character is crucial. A Berkshire CEO must be all in the company, not for himself. I'm using male pronouns to avoid awkward wording, but gender should never decide who becomes CEO. He can't help but earn money far in excess of any possible need for it, but it's important that neither ego nor avarice motivate him to reach for a pay matching his most lavishly compensated peers, even if his achievements far exceeds theirs. A CEO's behavior has huge impact on managers down the line. If it's clear to them that shareholders' interests are paramount to him, they will have few exceptions. Also, embrace the way of thinking. My successor will need one other particular strength, the ability to fight off the ABCs of business decay, which are arrogance, bureaucracy, and complacency. When these corporate cancers metastasize, even the strongest of companies can falter. The examples available to prove the point are legion, but to maintain friendships will assume only cases of distant past. In their glory days, General Motors, IBM, Sears, Roebuck, and U.S. Steel sat atop huge industries. Their strengths seemed unassailable, but the destructive behavior I deplored above eventually led each of them to fall to depths that their CEOs and directors had not long before thought impossible. Their one-time financial strength and their historical earning power proved no defense. Only a vigilant, determined CEO can ward off such debilitating forces. As Berkshire grows even larger, he must never forget Charlie's plea, "Tell me where I'm going to die, so I'll never go there." If our non-economic values were to be lost, much of Berkshire's economic value would collapse as well. Tone at the top will be key to maintaining Berkshire's special culture. Fortunately, the structure of our future CEO will need to be successful as firm in place. The extraordinary delegation of authority now existing in Berkshire is the ideal antidote of bureaucracy. In an operating sense, Berkshire is not a giant company, but rather a collection of large companies. At headquarters, we have never had a committee, nor have we ever required our subsidiaries to submit budgets, though many use them as an important internal tool. We don't have a legal office or departments that other companies take for granted. Human relations, public relations, investor relations, strategy acquisitions, you name it. We do, of course, have an active audit function. No sense being a damn fool to an unusual degree. However, we would trust our managers to run their operations with a keen sense of stewardship. After all, they were doing exactly that before we acquired their businesses, with only occasional exceptions. Furthermore, our trust produces better results than would be achieved by steep streams of directives, endless reviews, and layers of bureaucracy. Charlie and I try to interact with our managers in a manner consistent with what we would wish for if the positions were reversed. Our directors believe that our future CEOs should come from internal candidates whom the Berkshire board has grown to know well. Our directors also believe that an incoming CEO should be relatively young so that he or she can have a long run in the job. Berkshire will operate best if its CEOs average well over 10 years at the helm. It's hard to teach a new dog old tricks, and they are not likely to try at 65 either. Or have you noticed? In both Berkshire's business acquisition and large tailored investment moves, it is important that our counterparties be both familiar with and feel comfortable with Berkshire's CEO. Developing confidence of that sort and cementing relationships takes time. The payoff, though, can be huge. Both the board and I believe as we now have the right person to succeed me as CEO, a successor ready to assume the job the day after I die or step down. In certain important aspects, this person will do a better job than I am doing. Investments will always be of great importance to Berkshire and will be handled by several specialists. They will report to the CEO because their investment decisions in Broadway will need to be coordinated with Berkshire's operating and acquisition programs. Overall, though our investment managers will enjoy great autonomy in this area too, we are in fine shape for decades to come. Todd Combs and Ted Weschler, each of whom has spent several years on Berkshire's investment team, are first-rate in all respects and can be of particular help to the CEO in evaluating acquisitions. All told, Berkshire is ideally positioned for life after Charlie and I leave the scene. We have the right people in place, the right directors, managers, and prospective successors to those managers. Our culture, furthermore, is embedded through the ranks. Our system is also regenerative to a large degree, both good and bad. Cultures self-select to perpetuate themselves for very good reasons. Business owners and operating managers with value similar to ours will continue to be attracted to Berkshire is a one-of-a-kind and permanent home. It would be remiss if I didn't salute another key constituency that makes Berkshire special. Our shareholder, Berkshire, truly has an owner base unlike that any other giant corporation. That fact was demonstrated in spades at last year's annual meeting where the shareholders were offered a proxy resolution. Result. Whereas the corporation has more money than it needs, and since the owners, unlike Warren, are not multi-billionaires, the board shall consider paying a meaningful annual dividend of the shares. The sponsoring shareholder of that resolution never showed up at the meeting, so his motion was not officially proposed. Nevertheless, the proxy votes has been tallied, and they were enlightening. Not surprisingly, the A shares owned by relatively few shareholders, with large economic interest, voted no on the dividend question by margin 89-1. The remarkable vote that of our B shareholders, they numbered in hundreds of thousands, perhaps even totaling 1 million, and they voted 660,759,855 no, and 13,927,026 yes, a ratio of about 47-1. Our directors recommended no vote, but the company did not otherwise attempt to influence shareholders. Nevertheless, 98% of the shares voting said, in effect, don't send us a dividend, but instead reinvest all of their earnings to have our fellow earners, large and small, be so in sync with our managerial philosophy is both remarkable and rewarding. I am a lucky fellow to have you as partners, Warren E. Buffett. Vice Chairman's thoughts, past and future. To the shareholders of Berkshire Hathaway Incorporated, I closely watched the 50-year history of Berkshire's uncommon success under Warren Buffett, and now it seems appropriate that I independently supplement whatever the celebratory comment comes from him. I will try to do 5 things. 1. Describe the management system and policies that caused a small and infixably doomed commodity textile business to morph into the mighty Berkshire that now exists. 2. Explain how the management system and policies came into being. 3. Explain to some extent why Berkshire did so well. 4. Predict whether abnormal good results would continue if Buffett were soon to depart. And 5. Consider whether Berkshire's great results over the last 50 years have implications that many prove useful elsewhere. The management system and policies of Berkshire under Buffett, herein together called the Berkshire System, were fixed early and are described below. 1. Berkshire would be a diffuse conglomerate averse only to activity about which it could not make useful predictions. 2. Its top company would do almost business through separately incorporated subsidiaries whose CEOs would operate with very extreme autonomy. 3. There would be almost nothing at conglomerate headquarters except a tiny office suite containing a chairman, a CFO, and a few assistants who mostly help the CFO with auditing, internal control, etc. 4. Berkshire subsidiaries will always prominently include casualty insurers. Those insurers as a group would be expected to produce in due course dependable underwriting gains while also producing substantial float from unpaid insurance liabilities for investment. 5. There would be no significant system-wide personal system, stock option systems, other incentive system, retirement system, or the like, because the subsidiaries would have their own systems, often different. 6. Berkshire's chairman would reserve only a few activities for himself. 1. He would manage almost all security investments, with these normally residing in Berkshire casualty insurers. 2. He would choose all CEOs of important subsidiaries, and he would fix their compensation and obtain from each a private recommendation from a successor in one was only needed. 3. He would deploy most cash not needed in subsidiaries after they had increased their competitive advantage, with the ideal deployment being the use of the cash to acquire new subsidiaries. 4. He would make himself promptly available for almost any contact wanted by any subsidiary CEO, and he would require almost no additional contract. 5. He would write a long, logical, and useful letter of conclusion in his annual report, designed as he would wish it to be if he were only a passive shareholder, and he would be available for hours for answering questions at annual shareholders' meetings. 6. He would try to be an exemplar in a culture that would work well for customers, shareholders, and other incumbents for a long time, both before and after his departure. 7. His first priority would be a reservation of much time for quiet reading and thinking, particularly that might advance his determined learning no matter how old he became. 8. He would also spend much time enthusiastically admiring what others were accomplishing. 7. New subsidiaries would usually be bought with cash, not newly issued stock. 8. Berkshire would not pay dividends so long as more than $1 of market value for shareholders was being created by each dollar of retained earnings. 9. In buying a new subsidiary, Berkshire would seek to pay a fair price for good business that the chairman could pretty well understand. Berkshire would also want a good CEO in place, one expected to remain for a long time and to manage well without need for help from headquarters. 10. In choosing CEOs of such subsidiaries, Berkshire would try to secure trustworthiness, skill, energy, and love for the business and circumstances the CEO was in. 11. As an important matter of preferred conduct, Berkshire would almost never sell a subsidiary. 12. Berkshire would almost never transfer a subsidiary CEO to another unrelated subsidiary. 13. Berkshire would never force the CEO of a subsidiary to retire on account of mere age. 14. Berkshire would have little debt outstanding as it tried to maintain. 1. Virtually perfect creditworthiness under all conditions. And 2. Easy availability of cash and credit for deployment in times presenting unusual opportunities. 15. Berkshire would always be user-friendly. 2. A prospective seller of a large business and an offer of such business would get prompt attention. No one but the chairman and one or two others at Berkshire would ever know about the offer if it did not lead to a transaction, and they would never tell outsiders about it. Both elements of the Berkshire system and their collected size are quite unusual. No other large corporation I know of has half of such elements in place. How did Berkshire happen to get a corporate personality so different from the norm? Well, Buffett, even when only 34 years old and controlled about 45% of Berkshire shares and was completely trusted by all other big shareholders, he could install whatever system he wanted. He did so, creating the Berkshire system. Almost every element was chosen because Buffett believed that under him it would help maximize Berkshire's achievement. He was not trying to create a one-size-fits-all system for other corporations. Indeed, Berkshire subsidiaries were not required to use the Berkshire system in their own operations, and some flourished while using different systems. What was Buffett aiming at? He designed the Berkshire system. Well, over the years, I diagnosed several important themes. He particularly wanted continuous maximization of the rationality, skills, and devotion of the most important people in the system, starting with himself. 2. He wanted win-win results everywhere and gaining loyalty by giving it, for instance. 3. He wanted decisions that maximized long-term results, seeking these from decision-makers who usually stayed long enough in place to bear the consequences of decision. 4. He wanted to minimize the bad effects that would almost inevitably come from a large bureaucracy at headquarters. 5. He wanted personally to contribute, like Professor Ben Graham, to the spread of wisdom attained. When Buffett developed the Berkshire system, did he foresee all the benefits that followed? No. Buffett stumbled into some benefits through practice evolution. But when he saw useful consequences, he strengthened their causes. Why did Berkshire under Buffett do so well? Only 4 large factors occur to me. The constructive peculiarities of Buffett, the constructive peculiarities of the Berkshire system. 3. Good luck. And 4. The weirdly intense, contagious devotion of some shareholders and other admirers, including some in the press. I believe all 4 factors were present and helpful, but the heavy freight was carried by the constructive peculiarities, the weird devotion, and their interactions. In particular, the Buffett's decision to limit his activities to a few kinds and to maximize his attention to them and to keep doing so for 50 years was a lollapalooza. Buffett succeeded for the same reason Roger Federer became a good at tennis, but it was in effect using the winning method of the famous basketball coach John Wooden, who won mostly regularly after he had learned to assign virtually all playing time to his 7 best players. That way, opponents always faced his best players instead of his second best. And with extra playing time, the best players improved more than was normal, and Buffett much out of Wooden, because in his case, the exercise of skill was concentrated in one person, not 7 in his skill, improved as he got older and older during 50 years instead of deteriorating like the skill of basketball player does. Moreover, by concentrating so much power and authority in the often long-serving CEOs of important subsidiaries, Buffett was also creating strong Wooden-type effects here there. And such effects enhance the skills of CEOs and the achievements of the subsidiaries. Then as the Berkshire system bestowed much desired autonomy on many subsidiaries and their CEOs, and Berkshire became successful and well-known, these outcomes attracted both more and better subsidiaries into Berkshire and better CEOs as well. And the better subsidiaries and CEOs then required less attention from the headquarters, creating what is often called a virtuous cycle. How well did it work out for Berkshire to always include casualty insurers as important subsidiaries? Marvelously well. Berkshire's ambitions were unreasonably extreme, and even so, it got what it wanted. Casualty insurers often invest in common stocks with a value amounting roughly to their shareholders' equity, as did Berkshire's insurance subsidiaries, and the S&P 500 index produced about 10% per annum pre-tax during the last 50 years, creating significant tailwind. And in the early decades of the Buffett era, common stocks within Berkshire's insurance subsidiaries greatly outperformed the index exactly as Buffett expected. And latter, when both the large size of Berkshire stock holdings and income tax consideration caused the index part of returns to fade to insignificance, perhaps not forever. Other embedded advantage came. Ajit Jain created out of nothing an immense reinsurance business that produced both a huge float and a large underwriting gain. All of Geico came into Berkshire, followed by quadrupling of Geico's market share, and the rest of Berkshire's insurance operations usually improved largely by dint of reputational advantage, underwriting discipline, finding and staying within good niches, and recruiting and holding outstanding people. Then later, as Berkshire's nearly unique and quite dependable corporate personality and large size became well known, and the insurance subsidiaries got and seized many attractive opportunities not available to others to buy privately issued securities. Most of these securities had fixed maturities and produced outstanding results. Berkshire's marvelous outcome in insurance was not a natural result. Ordinarily, a casualty insurance business is a producer of mediocre results even when they are very well managed. And such results are of little use. Berkshire's better outcome was outstandingly large that I believe that Buffett would now fail to recreate if he returned to small base while retaining his smarts and regaining his youth. Did Berkshire suffer from being a diffuse conglomerate? No, its opportunities were usefully enlarged by a widened area for operation, and bad effects common elsewhere were prevented by Buffett's skills. Why did Berkshire prefer to buy companies with cash instead of its own stock? Well, it was hard to get anything in exchange for Berkshire stock that was as valuable as what was given up. Why did Berkshire's acquisition of companies outside the insurance business work out so well for Berkshire shareholders when the normal result in such acquisitions is bad for shareholders to acquire? Well, Berkshire by design had methodological advantage to supplement its better opportunities. It never had the equivalent of the Department of Acquisitions under pressure to buy it, and it never relied on advice from helpers. Sure to be prejudiced in favor of transactions, and Buffett held self-delusion at bay as he underclaimed expertise while he knew better than most corporate executives what worked and what didn't in business, aided by his long experience as a passive investor, and finally even when Berkshire was getting much better opportunities than most others. Buffett often displayed almost inhuman patience and seldom bought. For instance, during his first 10 years in control of Berkshire, Buffett saw one business, Textiles, move close to death and two new businesses come in for a net gain of one. What were the big mistakes made by Berkshire under Buffett? Well, while mistakes of commission were common, almost all huge errors were not making a purchase, including not purchasing Walmart stock. Then what was sure to work out enormously well, the errors of omission were of much importance. Berkshire's net worth would now be at least $50 billion higher if it had seized several opportunities. It was not quite smart enough to recognize this virtually sure thing. The next task on my list, predict whether abnormal good results would continue to Berkshire if Buffett were to depart. The answer is yes. Berkshire has in place its subsidiaries much business momentum growth and a much durable competitive advantage. Moreover, its railroad and utility subsidiaries now provide much desirable opportunity to invest large sums in new fixed assets, and many subsidiaries are now engaged in making wise bolt-on acquisitions. Provided most of the Berkshire system remains in place, and combined momentum and opportunity now presented so great that Berkshire would almost surely remain a better than normal company for a very long time if 1. Buffett left tomorrow. 2. His successor were a person of the only moderate ability. And 3. Berkshire never again purchased a large business. But under this, Buffett soon leaves assumption his successors would not be of only moderate ability. For instance, Ajit Jain and Greg Abel are proven performance who would probably be described as world-class. World-leading would be the description I would choose in some important ways. Each is a better business executive than Buffett. And I believe neither Jain nor Abel would, 1. Leave Berkshire no matter what someone else offered, or 2. Desire much change in Berkshire system. Nor do I think that desirable purchases of new business would end with Buffett's departure. With Berkshire now so large in the age of activism upon us, I think some desirable acquisition opportunities will come, and that Berkshire's $60 billion in cash will constructively decrease. My final task was to consider whether Berkshire's great results over the last 50 years have implications that may prove useful or elsewhere. The answer is plainly yes. In its early Buffett years, Berkshire had a big task ahead, turning a tiny stash into a large and useful company, and it solved their problem by avoiding bureaucracy and relying much on one thoughtful leader for a long time as he kept improving and bought in people like himself, compared to this little typical big corporation system with much bureaucracy at headquarters and a long succession of CEOs who come in at about age 59, puzzle thereafter for quiet thought, and are soon forced out by a fixed retirement age. I believe that versions of the Berkshire system should be tried more often elsewhere, and that the worst attributes of bureaucracy should much more often be treated like the cancers they so much resemble. A good example of bureaucracy fixing was created by George Marshall when he helped Win World War II by getting from Congress the right to ignore seniority and choosing generals. Sincerely, Charles T. Munger.